1989. He served as Education Officer, Board of Studies, the Institute of Chartered Accountants of India, New Delhi. Almost is to be completed in practice on 3 decades. Co-authored the book titled Taxman of Capital Gain, published by Taxman. He is a regular contributor to the column titled Update for SIRC newsletter. The tax referencer is authored more than 500 articles on taxation published in the Hindu Business Line, Taxman, ITR, and tax referencers. Besides the corporate professional today published by Taxman. This is very few words about him. I know very well about sir. Sir, kindly take the address. The floor is yours, sir.
Thank you. 1 minute. Let me ask Satish to share the screen. 1 minute. Share screen button.
Share screen. Screen.
Then
that screen could take problem.
There?
Double click. Double click.
அவ்வளவுதானே? Thank you, sir. Good evening, everybody. It gives me great pleasure to give this lecture on Union Budget 2021 with particular reference to direct tax proposals. In fact, when the budget was presented, the share market was zooming. It was a sort of a surprise that nothing great was coming in the budget except for the expenditure allocation. But the pundits of share market attributed the bull run in the share market too, that nothing was done to disturb the corporates. Probably the corporates were expecting some radical amendments to increase the revenue to the exchequer. I'm not sure what prompted the share market to have such a bull run. Of course, it's a record. Coming to direct tax proposals, before I start the topic, at the outset, I wish to thank the Erode branch chairman, Balamurugan sir, for giving me this opportunity to discuss on direct tax proposals. In the budget speech, the Honorable Finance Minister did not elaborate the so many amendments which they have done, and I thought the amendments were very few. But in the recent times, most of the finance ministers, they don't discuss the procedural changes, and therefore it is natural for those who observe the budget over the decades to see the fine print. If my memory is right, there are more than 70 amendments, section wise if you see. And these amendments can be debated. But I would say the changes in income tax law, more so in the facet of administration, is transformational in the recent times. So many changes are made, and those who have been practicing from paper written to this stage may find the changes are so many, more than handful. But if you just take a pass and think, what are the proposals? Why so many changes have taken place? I would say all these changes, majority of them are forward looking. I'm saying this only from the macro angle, not with reference to our class interest. I do not know whether chartered accountants with micro units being in focus will have a successful run, maybe in a decade or so from now. In the sense, we may get displaced with automation and simplification, and many more persons or institutions coming into the picture for collection of tax to the exchequer. You may all notice for the assessment year 2017-18, we had e-assessment where we were furnishing all the details in our registered account and confirming with the jurisdictional assessing officer to know whether he has received what we have submitted. It also happened that we checked with them what do they want personally and submitted them officially and ensured that not much of damage was done. Luckily, the demonetization assessments were like that. The Finance Act 2018 ushered in a new era, but many of us did not notice. In the Finance Act 2018, the legislature brought in three important sections: Section 143(3)(a), Section 143(3)(b), and Section 143(3)(c). These sections were like prelude to what is going to follow. In the sense, Section 143, the moment I say this, every one of you will know it is relating to assessment. 143(3)(a) gave the government the power to make a scheme for assessment of total income or loss without interface by imparting greater efficiency, transparency, and accountability by reducing the interface between the assessing officer and the taxpayer to the extent it is technologically feasible. From this, you can understand what they have meant. The second part is to optimizing the utilization of resources, through economies of scale. And the third one is having jurisdiction, faceless jurisdiction, team-based jurisdiction with dynamic jurisdiction and team-based assessment. These three sentences, like reducing the interface between the assessing authority and the taxpayer to the extent technologically feasible, then optimizing utilization of resources through economies of scale and functional specialization, and team-based assessment with dynamic jurisdiction, you will find being repeated in many places subsequently. But when this is stated, we could not catch what it is. Section 143(3)(b) was an enabling provision to empower the government to say that any of the provisions of the Act shall not or shall apply subject to exceptions, modifications, and adaptations. They can notify, they can give a direction which all of the sections will apply or will not apply, subject to exceptions, modifications, and adaptations. This direction will not be issued beyond 31st March 2022. Section 143(3)(c) is to say all the notifications after it is notified will be laid before each House of Parliament. Friends, I am just building the discussion. See, as chartered accountant, we need not just discuss the proposal. We have to understand the background under which these are coming. Why so many amendments are happening? What is the background? So based on this 143(3)(a), 3(b), 3(c), in 2019, September 12th, two notifications were issued, notification 61 and 62, providing for e-assessment scheme. Per se 61 stated what is e-assessment scheme. 62 stated what all are the legal provisions which will be subservient to the scheme. In the sense, the legal provisions cannot impair the applicability of e-assessment scheme. Then in the year 2020, August, they notified another two notifications came. Notification 60 and 61 in September 2020 to say what all are the sections, how it is going to operate. And the scheme was termed as faceless assessment. So originally it was e-assessment, then it became faceless assessment. They stated the scheme, then they stated what all are the provisions which will be subservient to the scheme. Then what happened? On 25th September 2020, they brought in a legislation. They called it as Taxation and Other Laws Relaxation and Amendment of Certain Provisions Act 2020, where the faceless assessment came within the statute book in section number 144B. So we had schemes. They had a trial run of the schemes. Then they brought it within the statute book itself. Now from 1/4/2021, we are going to have faceless assessment within the act itself. Not only this, there is going to be more than one faceless assessment schemes. One faceless jurisdiction, section 130 introduced to subsume section 124, 127, 129. Then we have faceless collection of information in section 135 to take care of 131, 133C, 133B, 134. Then you have 142, 142A. For that we have section 142B, faceless inquiry before assessment. Similarly, you have faceless revision in 263, 264. So even you have faceless registration for charitable trust and institutions. All this have been incorporated by the Taxation and Other Laws Relaxation and Amendment of Certain Provisions Act 2020. So what we can understand from all this is that the government is going for automation. In fact, an income tax return furnished 2 days back was processed. Today we got an information that the refund will be credited in 3 working days. Just today we got the SMS saying that it has been processed. So they are making use of the computer technology, economies of scale, functional specialization. They are using so much. They have a data mine. They have so much of information at their disposal. Previously, the government or the department could not really probe. Now they are able to, in press of a button, they can send the communication to so many persons who have not complied with the legal provision. So it is in this background we have to see how the budget proposals are made and how are we going to act and what is our scope. How are we going to survive with the changes? The first one, I am just assorting the changes section-wise from exempt incomes. Whether it is, I am taking it in the sense, we will take whatever is relevant in the context of domestic taxation. I am not taking international taxation, knowing fully well that its application or the usage is limited in our place. Coming to leave travel concession, section 10, subsection 5. We all know leave travel concession is exempt, but in the pandemic, how can the employees avail the leave travel concession? For this, the amendment says we can have the leave travel concession availed in cash and they need not go to their place, but they have to spend. It is to just encourage spending. Spending should be on GST expenditure at 12% or more. It should be by account pay cross check or demand draft or by any other mode covered by Rule 6 ABBA, and the quantum of exemption is 1/3 of the leave travel concession paid or rupees 36,000, whichever is less. And this concession will be included in the block of 2018 to 2021, that is calendar year 2018 to 21. In block of 4 years, it will be counted. So this salaried employees can avail the exemption. This benefit is from 12th October to we have up to 31st March 2021. The next one is contribution to EULIP. In fact, this is one of the controversial amendments, in my opinion, because how are we going to monitor? Already, the life insurers have to compute the amount of life insurance sum received by the insured. When it is subjected to tax, they have to deduct tax at source. Now, in section 10, subsection 10D, they are inserting 4th proviso and 5th proviso to tax ULIP, that is unit linked insurance plan. For this, they have made amendment in section 2 clause 14 dealing with capital asset to say it is consisting of insurance and investment. Correspondingly, it is covered by section 45(1)(b) for the purpose of taxing the amount received from unit linked insurance policies as capital gain. In fact, when it is subjected to capital gain, it is chargeable to tax either under section 111A or under section 112A. So accordingly, the amendments are proposed that it will be subjected to tax under those provisions with STT coverage also, and any unit linked insurance policy taken on or after 1st February 2021 will be subjected to tax provided the expenditure, the annual premium is more than 2,50,000. If it is less than 2,50,000, this amendment will not affect. So annual ULIP premium paid, if it is more than 2,50,000, section 10(10)D will not apply. Such amount will be subjected to tax, and the computation they will have to provide how much is 45(1)(b) also says how to compute the investment portion and insurance portion, and tax rate they have stated 111A or 112A. And where the legal heirs receive the amount on the demise of the person, such amount will not be subjected to tax. Therefore, it will be exempt from tax. This is the second one. The third amendment is contribution to statutory provident fund and recognized provident fund. We all know public provident fund, which we have been advising our clients to avail. Put public provident fund, which gives you a lot of flexibility in your annual investment. Coming to statutory provident fund and recognized provident fund, the amendment was made in section 17 to say if the employer pays more than 7,50,000 to the account of the employee in provident fund, SPF or RPF, then the income thereon, annual accretion, to the extent it exceeds the contribution. We all know 12% is the contribution which an employer can make. So if the amount of 7,50,000, to the extent it exceeds 12%, on that contribution part, annual accretion is chargeable to tax as income of the employee. Now in the same manner, it was about employer's contribution. Now in this Union Finance Bill 2021, for employees, if they contribute more than 2,50,000 rupees, then the amount of interest which is accruing to them will be chargeable to tax. It will be chargeable to tax under that income from other sources. When the employer contributes and you earn interest, it is called as income from salary. But when the employee contributes more than 2,50,000 and income is chargeable to tax because of the amendment in section 11, 10 subsection 11 and 10 subsection 12, such interest which accrues to the employee because of such contribution is chargeable to tax under the head other sources. So these are relating to salaried or general taxpayers. Now from the next item onwards, our practicing chartered accountants will have direct usage or application. We all know charitable trusts and institutions enjoy the benefit of tax exemption. Charitable trusts and institutions, as a matter of rule, have been receiving donation as corpus donation. This corpus donation, because of 11(1)(d), is not included in its aggregate receipt. Therefore, it is always goes off. It is not counted. But while computing the application, that amount which is contributed, that amount which is utilized, is used as application. This is sought to be curbed. Similarly, charitable trusts and institutions take loan. They avail loan. For example, an educational institution may avail a bank loan for purchase of bus to bring the students from the residence to institution and back. This loan taken for purchase of bus is shown as loan, but purchase of bus, the entirety is claimed as application. But I know there are certain chartered accountants who are so meticulous not to consider the loan as source, and to that extent, when it is applied, they reduce that. The loan amount is not considered as application to the extent it is utilized, but when the loan is repaid, it is treated as application. This is equitable. But many institutions, what they have done, the loan is taken as a loan, and acquisition of bus or capital asset, whatever capital asset, is treated as application. When the loan is repaid, that also is treated as application. So double deduction was obtained. This, to the best of my knowledge, many purists have brought to the notice of the finance ministry that there is double benefit obtained. Unless you make a proper amendment in the law, it is being abused. And in fact, the government heeded to the advice of those personalities and have sought to block the loan. The loan, when it is obtained, should not be considered for the purpose of application. Loan per se will be loan. When the loan is repaid, it can be treated as application. Then corpus donation, you are taking corpus donation. When you apply that corpus donation, you don't call that corpus donation amount as application. These are the two important changes. One more change they have brought, which I thought, which all of us know, that is, when the trust has excess application in the preceding years, this excess application in the commercial parlance, we call it as loss. If it is a business, we'll call it as loss. But in charitable trust and institutions, we call it as excess of application over income. This application was deducted upfront on the aggregate receipt itself. For example, the aggregate receipt is 3 crores, and if they have received, they have incurred excess application of 20 lakhs, that 20 lakhs is deducted from 3 crores. On the balance of 2.80 lakhs, that 15% was reduced. Now this is sought to be curbed. You don't compute your application upfront by deducting that amount, excess application or loss. You don't set off that amount of the preceding year. These are the 3 important changes. Besides this, we all know educational institutions existing solely for the purpose of education, when they have the aggregate annual receipt below 100 lakhs, they need not, they are getting blanket exemption. They are getting blanket exemption from tax. Similarly, medical institutions, when they have aggregate receipt below 100 lakhs, and if they are existing solely for the purpose of medical treatment or rehabilitation, not for the purpose of profit, they were having blanket exemption from tax, though return filing was a requisite. Now, it was felt that this 100 lakh is too small a sum. So what the finance bill proposes is that you are eligible to have that blanket exemption up to 5 crores, but this 5 crore is a combined blanket exemption monetary limit. In the sense, a trust running an education institution and having a medical institution, not for the purpose of profit, solely existing for the purpose of education or medical treatment, as the case may be, then the aggregate receipt, if it is less than 5 crores, they're eligible for blanket exemption. Hello, can you mute please? So this monetary limit has been enhanced to 5 crores. This is one of the important changes proposed in the finance bill. The next one is with regard to business income. With regard to business income, I'm sure members would have read something about all this and might have even done deep research into this. In the PGBP head, first I'm taking goodwill. See, way back about 2 decades back or 3 decades back, goodwill of a profession was not subjected to tax. Then it was brought. Now goodwill, they are making it, we all know goodwill is an intangible asset. Section 2 clause 11 deals with block of assets. Block of asset means group of assets falling within a class of asset in respect of which the same rate of depreciation is prescribed, consisting of tangible and intangible assets. What the finance bill proposes is that the goodwill should not fall within the block of asset. That is what they are intending. So they are amending section 2 clause 11 to say goodwill of business or profession will not be considered as asset falling within the block of asset. Thus, what would happen? We are not eligible to claim depreciation on goodwill. For that, they have made amendment in section 32. So goodwill is not a depreciable asset because of section 2 clause 11, and under section 32 it is taken away such that you cannot claim depreciation thereon, but it is liable to capital gain tax when it is sold. For that, the amendment is proposed in section 55 to say it is when it is a self-generated goodwill, the cost of acquisition will be taken as nil. When it is purchased, that value will be taken, assuming there is a goodwill for which you have claimed a depreciation so far. See, you purchased goodwill some 10 years back. You availed depreciation for 9 years. Now it is a depreciated value. Now in the depreciated value, now the goodwill you are going to sell. What will happen? So to the extent you have availed depreciation, that amount will be reduced and it will be compared to the sale consideration, and it will be short-term capital gain under section 50. This is on plain reading of the amendment. We will understand goodwill is no longer a depreciable asset falling within section 2 clause 11. But friends, what I felt is that the amendment is good. They blocked the goodwill from being eligible for depreciation. This amendment will upset the Supreme Court decision in Smith Securities Limited case. I think the citation is 348 ITR 302. Okay, but I have a point to make. Goodwill, when you acquire, say from now on, actual goodwill, you pay amount, it is not eligible for depreciation, but it continues to be a capital asset. It is not falling outside the definition of capital asset, which is defined in section 2 clause 14. Therefore, it is a capital asset, but it is not a depreciable asset. So what will happen? You buy a goodwill, and after some years you sell the goodwill. There is no embargo in indexation benefit. There is no amendment as such. When there is a purchase of goodwill, when you have incurred the cost, I think it is eligible for indexation. So the term goodwill is now akin to vacant land. We all know vacant land is not eligible for depreciation. In the same way, goodwill is also not eligible for depreciation. Like vacant land eligible for indexation, goodwill also be eligible for indexation if it is held for a period of 3 years or more. We can categorize it as long-term capital asset. There is no change in definition of long-term capital asset or short-term capital asset or capital asset. They have said what is the cost of acquisition. In indexation also, it will not impair. Only goodwill where depreciation has been claimed, that will be short-term capital gain upon transfer. This is the important change which I have brought, but it will apply in very rare cases in my opinion. The next one is employees' contribution to PF bar ESI. See, this is one of the controversies raging in the recent times. We have been disclosing the employees' contribution to Provident Fund or ESI and claiming that it is eligible for deduction even though there is some delay. This has been the uniform stand, and we have been furnishing in our tax audit report also. And CPC has been disallowing whenever or wherever there is a delay. This has been the standard practice. There are some decisions to say that section 36(1) VA, actually it is 5A, is covered by section 43B with the omission of proviso in section 43B. The employer's contribution and employee's contribution stand on the same footing. And when it is removed, applying the legal interpretation, a discomfort when it is removed, that discomfort should apply retrospectively. This is what we have been claiming and saying that PF contribution, even if it is remitted with delay, employee's contribution, it is eligible for deduction provided it is remitted before the due date for filing the return specified in section 139(1). Now what the government thought, they wanted to nullify all these decisions, and they are inserting an explanation in section 36(1) VA and section 43B correspondingly to clarify that employee's contribution, when it is received by the employer, it is income under section 2 clause 24, and when it is remitted even with a few days of delay, it is not eligible for deduction, and this will be independent of the employer's contribution, which is dealt with in section 43B clause B. So this is the amendment to nullify conflicting decisions given by various courts. So this is one of the important changes. But here, friends, I have a point to make. There is one school of thought which says the explanation is to clarify the government stand. The explanation is to clarify the government stand. Therefore, it is retrospective in nature. This is what is being stated. But if you notice, in the memorandum explaining the amendment, they have stated this is applicable. This is applicable from the assessment year 21, 22, and subsequent assessment years. So if the government has not stated, generally, one can say an explanation is clarificatory in nature. A clarificatory amendment is always retrospective. But when they have stated themselves in the notes on clauses that it is applicable from the assessment year 21, 22, and subsequent assessment years, then it is but natural for us to say for the earlier assessment years, up to assessment year 2021, we have furnished the return recently also. For such of those years, this amendment should not apply and disallowance should not be made. Because when a clarificatory amendment is made, we will say when you yourself have said that it is prospectively applicable, we cannot give retrospective effect. Of course, this can be debated, but when a provision is ambiguous or when the government legislature itself has stated in notes on clauses the date of applicability of a particular provision, when it is beneficial to the taxpayer, it is but natural for the taxpayers to claim that benefit. The third one is about residential property. Residential property, section 43 CA. This is a very important change to give fillip to real estate sector. We all know residential property could be a stock in trade. When it is stock in trade, section 43 CA will come into play. But when it is a capital asset, section 50C will come into play. Here, section 43 CA is being amended favorably to help the builders and developers. This is to give a better safe harbor cushion. The term safe harbor cushion means the variation. If the circle rate or guideline value is less than 110% of the apparent consideration, the difference between apparent consideration and the circle rate will not be subjected to tax, which is the present law. Now, in the Finance Bill 2021, what is sought to be made is increase that buffer level to 20%. So, if a property is 100 lakhs apparent consideration, if the circle rate is less than 120 lakhs, in such case, it will not impact the seller under section 43CA, and it will not impact the buyer because of section 56(2) clause 10, where a corresponding amendment is made. So this amendment covers two sections. The seller engaged in construction of residential property, selling a property, and the apparent consideration vis-a-vis the guideline value or circle rate, the difference is less than 20%. So I gave you the example 100 lakhs, 120 lakhs. If it is less than 120 lakhs guideline value or circle rate, both the seller who is having it as stock in trade and the buyer who is subjected to tax under section 56(2) clause 10 are spared. This is to give some fillip to the real estate sector, but there are some conditions embedded therein. The condition is the residential unit transfer should take place after 12th November 2020 and up to 30th June 2021. So it is only for a limited period this benefit could be availed. Second, it should be by way of first time allotment of residential unit. See, for example, I have a house property. I sell that house property. Can I avail this benefit? The first obvious answer is no. But assume I am a dealer in a house property and I have purchased a property from somebody as stock in trade. Now I am selling. In that case, it is not first time allotment. So it is a second sale or second hand property. So the condition is the timing 12th November to 30th June, 12th November 2020 to 30th June 2021. The second is the transfer is by way of first time allotment of residential unit. The third and most important is the consideration should not exceed 2 crore rupees. So only for properties less than 2 crore, this benefit could be availed. Most importantly, we may note this enhancement of 20% is not applicable for 50C in the sense where a residential property is held as capital asset, where it is held as capital asset and it is sold with a difference of 20%, 18% or 19%, this concession proposed in the finance bill will not apply. So this is a limited period and having limited scope. The next one is about tax audit. See, there has been a big hue and cry that by enhancing the limit for tax audit, the opportunity of our fraternity is curtailed. This is what is being stated. Now, in the last budget, we saw the tax audit limit was extended to 5 crores, where the cash transactions, aggregate of receipts and aggregate of all payments was less than 5%, and the gross turnover or gross receipt is less than 5 crore, tax audit is not required, and you can furnish the return as reflected in the books of account maintained by the assessee. So this was intended to provide relief to the taxpayers in compliance. Obviously, it will reduce the compliance cost of the taxpayer. That was the basic objective. In the Finance Bill 2021, what they are proposing is they are extending. My humble submission is the fiscal policy or the tax policy, whenever it is created, the government has to wait for the policy to stabilize. We have to give a couple of years or more for the people to plan how to go about it. Last year only it was enhanced to 5 crores with a very stiff condition that cash transaction, cash receipt or aggregate of cash payments should not exceed 5% to be outside the tax audit requirement. But I do not know whether all the sectors, particularly in tier 2 or Mufasal areas, any taxpayer would have such kind of discipline to have digital transactions to overcome this audit compliance requirement. In fact, they would be happy to violate the provision and be safe with us only and permit us to do tax audit. Be that as it may, in the Finance Bill 2021, what is proposed is if the aggregate of receipts and aggregate of payments by cash payment is less than 5%, and with the gross turnover, gross receipts, whatever, is 10 crores, up to 10 crores, tax audit under section 44AB is not required, and the book results can be mapped in your ITR and you can file the return. But in my humble opinion, in metro cities where small scale BPOs and KPOs with turnover of less than 10 crores, if they have the discipline to do all digital transactions, I think they can get the benefit out of it, considering the fact that the compliance cost is comparatively higher in those places than in other places. This is one of the changes proposed, but it remains to be seen whether it will impact the chartered accountant fraternity so much so. Because chartered accountants in tax audit report give so much of information. These informations are just ready-made for verification by the department, and these days the informations are rigidly required. We cannot escape. For example, when we say the inventory verification was not done by us but certified by the management, and when it is selected for scrutiny, they say, how do you certify the inventory value? Or if you gave a disclaimer in 44AB report saying that inventory register not available for audit, even if I say it is not available for audit, they say, how do you certify the inventory value for the purpose of tax audit? So we are also cautious, and we want to safeguard ourselves by giving due disclaimers in our tax audit report in 3CA or 3CB, and the department is able to scan the contents of the report and they're able to see what we have stated. It is not just a copy and paste. 20 years back, tax audit report used to be just not applicable. They will put NA. You will not whether it is not applicable or not available. We don't know. But now with rigid requirements, we have to give definite information. Even in respect of tax and duty 43B, they ask whether it is routed through profit and loss account or it is not routed through profit and loss account. Of course, this is debatable whether it is mandatorily to be routed through profit and loss account or not. In the background of ICDS 2, inventory valuation, which seeks duties and taxes have to be considered in inventory valuation. And similarly, section 145A, which says inventory has to be valued inclusive of duties and taxes and all expenses incurred to bring it to the present location. Just I'm leaving it there. The point I'm making is by circumventing the tax audit, I would say the taxpayers to a large extent would only be in some perils, because as chartered accountant, we have been doing qualitatively a great service, and disclosure requirements, advisory role we have been playing. And I do not think this 44AB enhancing the turnover limit to 10 crores with a digital transaction backup is going to really help the government and may not have a lot of takers to affect our profession. This is my personal opinion. The next one is presumptive income, section 44 ADA. See, section 44 ADA is applicable for professionals when they have the aggregate income, aggregate gross receipt below 50 lakhs, they can admit 50%. Here, the amendment is not with regard to enhancing the monetary limit or reducing the presumptive income percentage. It is to say that to whom it is applicable. It is applicable to individual, it is applicable to HUF, it is applicable to partnership firm, and the government this time. They thought it should not be applicable to LLPs, obviously for the reason that the LLPs have to mandatorily maintain books of account, and they cannot say I will offer the income under presumptive scheme under 44 ADA. But one of the issues raised in the recent times is how a profession could be practiced by HUF, because profession is a qualification, a recognized qualification. Profession is different from vocation. For example, a person giving a religious discourse or a philosophy is a vocation, different from profession. I just checked with section 44 AA to see the profession. I found only one item, interior decoration. Then I thought whether interior decoration is a recognized profession or not. Then I checked up with the university authorities to know that interior decoration is a separate qualification prescribed in the engineering. Therefore, like fashion designing or architecture, interior decoration is also a recognized qualification. So once a recognized qualification is attached to education, it cannot be owned by a Hindu undivided family which has members addition due to birth or reduction due to death. So, but the amendment is limited to say the LLP is not eligible for the presumptive income scheme specified in 44 ADA. The next thing is changes in capital gain, retirement of a partner. Of course, when I say retirement of a partner, all who have been closely following the legal provisions would immediately recall so many decisions. We have the decision of very old Bhagyalakshmi and Co case, 55 ITR. Then we have A.N. Nayak's case. Then we have Rashiklal and Co.'s case. Be that as it may, what is sought to be done now? When a partner retires from a firm, there is no issue at all. He will receive the money from the firm and retire from the firm. No issue. But if a partner retires from the firm and takes some capital asset, for example, an immovable property owned by the firm is given to the partner. What happened in A.N. Nayak's case? When the immovable property is given by the firm to the partner in settlement of his dues or capital in the firm is liable to capital gains tax by applying section 45 subsection 4. In the case of dissolution of firm, what will happen? Same section 45(4). In the case of dissolution of firm, we have Supreme Court decision, ALA firm case, and another is Shakti Trading Company. Proponents of taxation know that if the partnership deed contains a condition that the firm will not be dissolved on the demise of a partner, there is no dissolution of firm. It is just dissolution of partnership. There is no distribution of asset. The firm would survive. The PAN number would be the same. The GST would be the same. Now, what is sought to be done is to block distribution of assets to a partner on retirement or dissolution and provide for taxation. The Finance Bill 2021 wants to insert section 45 subsection, wants to substitute section 45 subsection 4 and insert subsection 4A to section 45. The idea is when a partner retires from the firm and takes a capital asset from the firm and the fair market value of the capital asset will be ascertained and what is the amount standing to his credit in the capital account will be compared, and the firm called as specified entity in this section will be subjected to tax. For the purpose of ascertaining the partner's capital account, any revaluation made will be ignored. Similarly, any intangible asset, self-generated goodwill, self-generated brand value, know-how, whatever fictional entries we are making, those will be ignored for the purpose of ascertaining the partner's capital, and it will be compared with the fair market value of the asset which is given to the partner in settlement, and the firm will pay tax. Okay, this is 45.4, which we could understand. Come to section 45.4a. This is not capital asset. This is any money or other asset. The word used is any money or other asset given to a retiring partner, by a firm on dissolution or change in constitution. In such case also, the same methodology will be adopted. But I have a small issue here. See, section 45.4 was standing on the firm foundation, dissolution of firm and distribution of assets. Now, if you notice section 45.4a, if you see 45.4a or 45.4, it is not saying distribution of assets. 45.4 says, notwithstanding anything contained in subsection 1, where a retired partner receives capital asset at the time of dissolution of the specified entity. If the partner does not receive capital asset on the dissolution, what will happen? I think here section 45.4 and 45.4a uses three expressions: specified entity, specified person, self-generated goodwill, and self-generated asset in the same paragraph. But they have not used the term dissolution of firm, dissolution of specified entity. When the entity is dissolved, there can be no distribution also. The entity may continue. There is a pure commercial distinction we can draw between dissolution of partnership and dissolution of firm. Dissolution of partnership happens even when retirement takes place. But retirement of firm will take place when the firm is dissolved, lock, stock and barrel. So when the firm is not dissolved, when it is continued, I think if there is no distribution, by postponing the distribution, like before, we can block the applicability of section 45.4a and the taxation also. To what extent this provision is going to be operative, and whether it could be challenged to say, when there is a dissolution of firm and in the absence of distribution, this provision will not apply. Or even when there is a dissolution of firm per se without any action further, whether a notional income could be attributed thereon. Because they have to say how they are going to arrive at the net worth of the firm by valuing the fair market value of assets. These methodologies, in my humble opinion, have not been detailed in section 45.4 and 45.4a. I think they can insert one more section to say, when there is dissolution of firm, even without distribution of assets to the partners, how are we going to deal with that? When there is no distribution, I think section 45.4a will not come into play. The next is slump sale. See, slump sale, very sparingly used. It is sale of undertaking. Sale of undertaking without assigning values. Without assigning values to individual assets and liabilities. If an entity has one undertaking in Tamil Nadu, another undertaking in Pondicherry, and if the undertaking in Tamil Nadu is sold, say in Kadalur, and another undertaking in Pondicherry proper, the undertaking in Kadalur, when it is sold, if the assessee has maintained identity and without assigning values to individual assets, and if the undertaking has been operational for 3 years or more, it is eligible to be taxed as long-term capital gain, provided no individual values are assigned. So what has happened, the taxpayers have taken advantage of this, naturally of course, that they will assign the values unofficially to each of the assets and the actual liability also, and ascertain the consideration. No person will blindly value a transferable undertaking. Definitely there will be some internal calculation to arrive at the net worth of the undertaking. Now, what has happened? There were instances where the slump sale is made for which the consideration is received in the form of exchange. Some other asset is obtained or something is given by way of in kind, say shares of companies. There were some litigations. So the legislature thought whatever loopholes are there, we have to block the loopholes. Now what they have said, the slump sale will cover, any transfer. Transfer includes exchange, relinquishment or extinguishment. The definition of transfer is quite wide. So they want to incorporate the term transfer within the slump sale definition to say when any transfer is made, slump sale of undertaking for a transfer. So whatever be, whether it is exchange of asset, then also it is covered by slump sale. You cannot say it is not a slump sale. This is what is sought to be achieved in the proposed Finance Bill 2021. The next one is about benefit of 20%. Sections 43CA and section 56.210. I told you 56.210 is transfer of immovable property for inadequate consideration or without consideration from a non-relative. You know the term relative which is given. We can put a flow chart to know who is relative or who is not relative. And without consideration, when it is received from non-relative, when the amount exceeds 50,000, it is chargeable to tax. When it is from relative, it is not chargeable to tax. When it is for inadequate consideration, the monetary limit is 50,000. And you know, the amendment is proposed in the finance bill to say the cushion of 20%, which I have narrated when I was discussing section 43CA. The next one is extension of time, section 54GB. See, section 54GB is a classic provision to provide tax incentive. For example, a person has remained in Middle East for 10 years. After 10 years, he comes back to India and he wants to have a startup unit to do some original research for inventing something which is recognized by the government also. So now to fund that unit, he is selling a residential property or land and he is deploying that amount, net consideration, in the startup unit. So when he does that, he is eligible for exemption under section 54GB. Now there was a sunset clause. This 54GB was to operate only up to 31/3/2021. Now in the Finance Bill 2021, they are extending the time to 31/3/2022, whereby if a startup unit is incorporated up to 31/3/22, then also the exemption under section 54GB could be availed. Chapter 68 deductions. Section 80 EEA. We all know section 80 EEA is for providing some extra incentive for purchase of first residential house. There are some conditions embedded therein where the cost of the house should be 45 lakhs. The assessee should not own more than any residential house on the date of sanction of the loan. It should be the first house which is acquiring and is eligible for deduction of 1.5 lakhs in respect of interest on monies borrowed for the purpose of acquisition of this house. Immediately one may think, why the section 80 EEA when we have section 24? Of course, section 24 limits the quantum of deduction in respect of interest on monies borrowed to rupees 2 lakhs, not more than that. In fact, even if it is residential property let out, the loss from a house property hit cannot exceed 2 lakhs. Now section 80 EEA is an extra deduction. For example, my interest on monies borrowed for the year is 3,20,000. Subject to satisfaction of all conditions given in section 80 EEA, I avail 2 lakhs under section 24 and I can claim deduction of 1,20,000 under section 80 EEA. All these are fine. What is special about it is that they have extended the time for acquisition of house property, which was supposed to end by 31st March 2021 to 31st March 2022. So one more year they have given this extension. So any person willing to buy the first residential property, subject to all the conditions embedded in section 80 EEA, can go for it. He is eligible for that extra deduction available in 80 EEA besides section 24. The next one is section 80 IBA. Section 80 IBA is about startup units. Startup units, I told you about 54 GB. 54 GB I told you. Sorry, 80 IBA is not startup unit, this housing project, sorry. See, housing projects are eligible for 100% deduction. The thrust of this budget, I would say, is on real estate sector, because many real estate companies have huge unsold stock of inventory. So in what best manner they can be given a push that is sought to be achieved. Now section 80 IBA provides 100% tax exemption in respect of housing projects which have been approved after 1st day of June 2016, but on or before 31st day of March 2021. In the Finance Bill 2021, they are extending the cutoff date to 31st March 2022. So any housing projects which is approved up to 31st March 2022 will be eligible for exemption under section 80 IBA, subject to various conditions stated therein, like square foot area, square foot meter, how much should be the commercial area, so many things. Yet another fillip sought to be given for real estate sector is regard to affordable rental housing project. The Honorable Finance Minister, while presenting the budget, made a cursory reference saying that there are so many migrant workers, they require some cheap accommodation, rental accommodation, so that they can survive in the place where they are provided job opportunity. Now the government is likely to come up with a affordable renting housing project by notification the official gazette. So such of those projects, when it is approved, when it is approved before 31st March 2022, the taxpayer can avail exemption under section 80 IBA, but the finer aspects of this scheme, affordable housing project scheme, remains to be seen. What are they going to say? We have to wait. The next one is section 80 IAC, which I told you, startup units. See, startup units, when they have something innovative with a turnover up to rupees 100 crores, are eligible for 100% deduction in 3 consecutive assessment years out of 10 years at the option of the taxpayer. Now here also, the startup has to be incorporated on or after 1st day of April 2016, but before 1st day of April 2021. This 2021 is sought to be extended to 31st March 2022. So for startup units, they are extending the time. For investment in startup units, to avail exemption to 54 GB, they are extending the time. For housing projects 80 IBA, for approval, they are extending the time. They are going to come up with a affordable housing project which they are going to devise, and when it is approved before 31st March 2022, it is eligible for exemption. Then section 80 EEA, where the first residential house of a taxpayer, when it is less than 45 lakhs, acquired up to 31st March 2022, is eligible for extra deduction of 1.5 lakhs besides section 24 deduction. This is how the real estate sector. Not only this, you have section 43 CA, where stock in trade, when it is sold, the 20% safe harbor rule, that cushioning effect is given, but not for 50C, please remember. Then 56(2)(10) for the buyer, when the circle rate is the difference between the apparent consideration and the circle rate is less than 20%, The buyer is also spared from addition under section 56(2). Like this, so many fillip's are given and incentives are given, particularly in real estate sector, to move the economy to have V-shaped recovery. Now we are coming to compliance aspect. We all know the time limit for filing the ITRs. Now, in the recent times, even a belated return could be revised. For a long time, we were under the impression only a return filed under section 139(1) could be revised. Couple of years back, an amendment was made, a belated return can be revised. But in the finance bill, what they are saying is, the time limit for filing the return, is being curbed. It is now being stated in a sort of a reverse fashion. So to say, 3 months before the end of the assessment year. So a belated return cannot be filed up to the end of the assessment year. It can be filed at any time 3 months before the end of the assessment year. So for example, for the assessment year 21-22, the cutoff time will be 31st December 21 and not 31st March 22. Similarly, for revised return also, they are saying the time limit is 3 months before the end of the assessment year. So what the government probably thinks is that the taxpayers have to be alert, compliant. As early as possible, you comply with the legal provision. But they have a master plan, in my opinion, to seek compliance. See, belated return will end. You cannot file a belated return beyond 9 months from the beginning of the assessment year. In my language, the legal language is 3 months before the end of the assessment year. That is the cutoff date beyond which you cannot file a belated return. Similarly, you cannot file a revised return. Then defective return. We all know defective return, the concept of defective return. Section 139, subsection 9 has a list of defects. But some of the defects listed therein you will find are not applicable. In the sense, they may not be relevant with the digital return filing. We are filing e-filing of return. Some of the defects stated therein may not be useful or relevant. Now, what is sought to be done is that in the case of defective return, the board is going to be empowered. The board is going to be empowered to specify whether the list of defects given in section 139(9), any of those defects shall not apply to any class of assessee or any class of income. They can say. So some elbow room is given, sought to be given in the finance bill for defective return by empowering the CBDT. Coming to assessment. See, for filing the return, they have reduced the time. For filing the return, they have reduced the time as against 12 months. Now it is only 9 months. So 3 months before the end of the assessment year, return has to be filed, whether it is a original return or a belated return or a revised return, whatever it be. Now, notice for assessment under section 143(2). Before this, if you notice section 143(1), what is the present limit for giving intimation under section 143(1)? The present limit is 12 months from the end of the assessment year. So if the return is filed on 31st March, intimation under section 143(1) will be given within 12 months. Now that is sought to be reduced to 9 months. So in 143(1), an intimation will be given within 9 months from the end of the assessment year. 143(2) is for scrutiny assessment. What is the time limit originally? 6 months from the end of the assessment year in which the return was filed. Okay. Now this is sought to be reduced to 3 months from the end of the relevant assessment year. So when we file the return by 31st December 2021, notice under section 143(2) will be served before 30th June 2022, not beyond that. So within 3 months to the end of the assessment year, notice under section 143(2) will come. This is something very interesting in the sense we have to file the return yearly and notice will come within 3 months, but intimation can come beyond that 3 months. In the sense 30th June 2022, you will receive scrutiny notice, but your intimation can come on 31st December 2022 because of the extended time. But the reality is we are getting intimation in 2 days, 3 days like that. The next one is expanded scope of section 147. See, section 147 is sought to be substituted. It is not amended. Section 147, they are substituting the entire provision. We are going to see a difference. If any income chargeable to tax has escaped assessment for any assessment year, the assessing officer may, subject to the provisions of section 148 to 153, assess or reassess such income or recompute the loss or depreciation allowance or any other allowance or deduction. One glaring difference what I see is that we all know where a notice is issued, 148 notice is issued and assessment under section 147 is made. If the notice under section 148 is issued for few reasons and such of those reasons do not stand the test of scrutiny, and the assessee is able to say that there is no escapement of income, there is one Bombay High Court decision in Jet Airways case where the assessing officer cannot advert to new source of escapement of income. He cannot find a new head or new source of escapement of income. Whereas there is one contrary decision of Delhi High Court in Ranbaxy Laboratories case where the court held not only the original reason, even if the original reason for which reassessment proceedings were initiated does not survive, for some other reason, but some other reason survives, reassessment is possible. So we had two conflicting decisions, Jet Airways and Ranbaxy Laboratories. Now the Finance Bill 2021 approves the Ranbaxy Laboratories case to say, even if the original reason for reassessment does not survive, some other reason is able to survive in the course of reassessment, then 147 could be made. This is how I look upon the reading of section 147. Then we have section 148A. Friends, this in this faceless assessment or faceless reassessment under section 151A, a scheme is to be rolled out. They have to roll out a scheme for faceless reassessment also by virtue of section 151A, brought in by Taxation and Other Laws, Relaxation and Amendment of Certain Provisions Act 2020. The government has huge network of information. It has a data mine. It is only how they are going to use. Now 148A is a very good provision where the assessing officer, before issuing notice under section 148, must make an inquiry. Earlier they were used to give notice, and as a taxpayer we used to ask for reason, and based on the Supreme Court decision in the case of GK and drive shafts case, the assessing officer is duty bound to give the decision, and the assessee can rebut those reasons for escapement of income, saying that there is no escapement of income. The assessing officer can drop the proceedings, or he has to pass a speaking order. He has to pass a speaking order saying that there is escapement of income before going further. This is what the Supreme Court has stated. Now what is happening is, in section 148A, the assessing officer must make an inquiry. This inquiry, the assessing officer has to make compulsorily, and it should be done with the previous approval of the specified authority. So what is sought to be achieved is, the government wants to be very fair. We give you a fair chance. It is not the lower rung of the assessing officer, say the ITO or AC is going to decide. It is at the principal chief commissioner or the principal commissioner or principal DGIT or DGIT who will approve such inquiry. So I think in this sort of cases, we can give a proper reply. If the case is a genuine case where you have sufficient ground to say there is no escapement of income, that would be a fair play. I think the law is being made very transparent by throwing you the information, you rebut the allegation with proper replies, and even if your reply is not satisfactory, then they will proceed. So it is a fair game where there is no hanky-panky or half measures. It is a straight, they will make an inquiry, and based on inquiry, the inquiry is not suo motu by any assessing officer. For that matter, if you see, the entire department as of now is dismantled. You have assessment unit, verification unit, technical unit, review unit. The assessment unit will do assessment only. And if it wants some technical inputs, it will go to technical units. If it wants any inquiry to be made, whether books of accounts to be examined, it will go to verification unit. If its order, it cannot so more to ask, the National Faceless Assessment Center will decide whether the assessment order passed is adequate. If it is not prejudicial, it may accept, or it may send it to review unit. The review unit will say whether the order is proper. If the order has apparent gaps or unjustified additions, then the review unit can say it is not proper. Then it will not go to same assessment unit, it will go to some other assessment unit. So see the checks and balances they have incorporated in the faceless assessment scheme. The assessment unit will be manned by the assessing officer in the rank of ITO or AC or JC or DC. Then up above them, you will have additional commissioner or joint commissioner. Then after both of them have applied, it will go to review unit. There also you have assessing officer, and above them there is a joint commissioner or additional commissioner. So it is a group-based assessment with dynamic jurisdiction. If the review unit is not satisfied and says some suggestions, it will not go to assessment unit, it will go to some other assessment unit. That assessment unit again will peruse the record, and they will again prepare the draft assessment order. So lot of checks and balances are kept. Now in inquiry before assessment also, section 148A, there will be an inquiry. They will make an inquiry with sufficient time. They will give not less than 7 days, but not more than 30 days. The taxpayer can ask extra time. That extra time also they will give. Then we can give reply saying that there is no escapement of income. After considering the reply, they will give a notice under section 148 by passing an order. Within 1 month from the end of the month in which the reply is received for invoking section 148. So 148A acts as a prelude to 148. So it should actually, in my opinion, it should have been stated as 147A. So that first inquiry, then issue of notice. They have put issue of notice in 148 and put inquiry before assessment. The numbering has gone beyond 148. It should have come as 147A to say inquiry before reassessment. So they will make an inquiry and they will say whether there is 7 days time minimum, maximum 30 days, extra extended time also they will give. Then they will pass an order, and in case they are going ahead with the reassessment, and based on that, reassessment notice will be issued. Now 148 notice is issued. Now the reassessment notice, when it is issued, the regular proceedings will go. Once a notice under section 148 is issued, it is deemed that the assessing officer has information for escapement of income. So he will proceed for making the assessment. Of course, we have the right or the privilege to counter his observations and have the natural recourse to appeal proceedings. That is apart. Now, there are certain instances where the assessing officer is deemed to have, information. What all are they? Where the case is subjected to search under section 132 or requisitioned under section 132A, where the books of accounts have been requisitioned, or any money, bullion, jewelry have been requisitioned after 1st April 2021, or a survey under section 133A was carried out on or after 1st April 2021. In these cases, they need not have recourse to 148A. They can straight away go to 148 because they have the information. This is 148A is to give information, prepare the base. But such base is not required when it is a search case and 132 or 132A or 133A or any money, bullion, jewelry or other valuable article or thing have been seized or requisitioned on or after 1st April. So in such of those conditions, then the process of 148A need not be carried out and they can straight away start the 148 proceedings. So this is how the checks and balances are sought to be made. I think all these are very innovative. And if in fact the search assessment, whatever is made, whatever search is made up to 31st March, that alone will be governed by section 153A, 153C, and any search conducted on or after 1st April 2021 will go to a regular provision like 148. We'll come to that later. The next one is time limit for reopening the assessment. See, here it could be debated. We all know the time limit for reopening the assessment was kept a few decades ago for 8 years and 16 years, two-tier system. Then it became 6 years and 10 years. 6 years regularly and 10 years. Now we have 4 years, 6 years and 10 years. Now the Finance Bill 2021 wants to reduce the time limit to 3 years and 10 years. So the time limit is sought to be reduced. I think here, personally, I feel they need not have reduced the time limit because at a later date, you cannot increase the time limit. If you increase the time limit, the assessee will very well say, I have not maintained the books of account. Since you have reduced for the reduced time limit only, I have maintained the books. I cannot have recourse to the old years. This is possible. Now, what they have said is that the reassessment will be for 3 years preceding the previous year in which the notice is sought to be issued. For example, now they are going to issue notice. Now it is 22 February. Now 21, 2019. I'm not just I'm comparing and telling you. So 3 preceding previous years, previous years relevant to the previous year. So it cannot go beyond 3 years. The next part is where the income escaping assessment is more than 50 lakhs. If it is more than 50 lakhs, they can reopen the assessment for 10 previous years. Here also, I am not fully satisfied with the language it is stated. Just I will read. If 3 years but not more than 10 years have elapsed from the end of the relevant assessment year, unless the AO has in his possession books of account or other documents or evidence which reveal that the income chargeable to tax represented in the form of asset, you note down this expression, represented in the form of asset which has escaped assessment amounts to or is likely to amount to 50 lakh rupees or more. So the phrase represented in the form of asset, what I read from this is that I have not disallowed 40A3. I have not deducted tax at source, and there is disallowance under section 40AI or 40AIA. The amount exceeds 50 lakhs or even 2 crores or 3 crores, whatever. There is a tax liability if you are able to lay hands on those books and the tax liability is more than 50 lakhs. The expression used is represented in the form of asset. A disallowance of expenditure is not represented in the form of asset. Disallowance of expenditure for non-deduction of tax at source is not represented in the form of asset. Therefore, such of those cases, even though it is more than 50 lakhs. So what will happen if I have unaccounted vacant land, unaccounted jewelry, unaccounted bank deposit, unaccounted cash, and it is more than 50 lakhs. So if it is more than 50 lakhs, in such of those cases only, this 10 years will apply. For example, in the financial year 15-16, I have not deducted tax at source, I have not disallowed. People come for survey under section 133A and they are able to see the old books. Whether it is justified or not is debatable. They are seeing the books, they are taking the books. It can happen. But if you see this 149(1)(b) proposed to be inserted, they cannot reopen the assessment because it is not represented in the form of asset. This is what this expression, whether it is intentional or accidental, I do not know. Because legal draftsmen, we put them in high esteem to say they know the language. But if you read this section, I will say they have said in his possession books of accounts. The correct expression should be books of account only. It is not books of accounts. Books of account, that should be the correct expression. C1 45(4) and 4A. I feel these days the legal drafting is undergoing a transformation. Though the intention behind the drafting or the logic behind the drafting of legal provision or the rationale of the legal provision or the tax administration, while it is appreciable, the language displayed requires little bit of care and caution. So sanction for reassessment. This is another section, 151. Here, who will sanction reassessment? See, the legal provisions are now being drafted with a lot of safety measures, but it could be interpreted like this also. All the powers are taken by civil servants. The income tax officer or the others may not have much of powers. All the powers have gone to the top level. Now, when the reassessment is sought to be reopened for an assessment year, which is less than 3 years, it is a principal commissioner or principal director or commissioner or director. So it is not a joint commissioner or joint director or additional commissioner or additional director. Then when it is 10 years, when the reopening is say 7 years or 8 years, which falls within the time bandwidth of 10 years, it is principal chief commissioner or principal director general, or where there is no principal chief commissioner or principal director general, it is a chief commissioner or director general. So the powers are given at the top level. So the scope for abuse of powers is almost removed, you can say. And the faceless assessment, with my little experience, I would say the tax administration is also cautious. They cannot brush aside our arguments, our replies, or our grounds, because it is team-based assessment, dynamic jurisdiction. But from what I have interacted with the team-based assessment also personally, in team-based assessment, the accountability is joint and several. but not much of several, it is joint. Therefore, if somebody says, I will make only this much of addition in the assessment unit, the review unit may not have much of enthusiasm to suggest many more additions or damaging additions, so to say. So in team-based, the advantage is there is proper check and balance. It cannot be an onslaught on the taxpayer. But at the same time, when assessment unit does something, the review unit may silently approve them and may get away, and there is no accountability on their part. They will say, the assessment unit has done, we have approved. Similarly, assessment unit, if they don't display the dynamism, they may not seek the services of technical unit. Technical unit may give legal decisions, legal position, circulars, all that, which they may not avail of. In such case also, the technical unit may become dormant or not exploited to the extent it is intended. The next one is time limit for assessment. See, you know, for filing the return, it is 31st December. For issuing notice under section 143(2) for the purpose of scrutiny assessment is 30th June, that is 3 months from the end of the assessment year. Now, what is the time limit for assessment? I said for intimation, they have given more time, 9 months from the end of the assessment year. For notice under section 143(2) is 3 months from the assessment year. For assessment also, they are reducing the time limit to 9 months. 9 months from the end of the assessment year. So 31st March 22, the notice will be 9 months from the end of the assessment year in which the notice was issued. I'm sorry. So it is 9 months from the end of the assessment year in which the notice was issued. And for reassessment, there is no reduction in time limit. The reassessment survives. It will be 12 months from the end of the assessment year in which the notice was served. So there is no amendment in section 153 subsection 2 for reducing the time limit for reassessment. Only for assessment 153 subsection 1, the time limit is reduced to 9 months from the end of the assessment year in which the notice under section 143(2) was issued. The next one is search assessment. I told you already, in respect of any search conducted on or after 1st April 2021, there will not be a separate search assessment. In fact, the faceless assessment, e-assessment and 2019 or faceless assessment 2020 by virtue of schemes, and faceless assessment under section 144B from 1st April 2021 will have search assessment. Now we'll have search assessment also. Earlier, search assessment and international taxation, these two divisions were, that is, we call it as central circle and international tax divisions, were not brought within the faceless assessment. Now search assessment by virtue of section 148, 148A, 149, 151 and 147 now comes within the regular faceless assessment scheme only. So even if you take any survey after 1/4/2021 or search after 1/4/2021, all these assessments will fall within the faceless assessment under 144B with effect from 1/4/2021, and search assessment we need not have to go to the central circle where it will be subjected to assessment. The next one is TDS and TCS. Relief to senior citizens from filing ITR. See, section 194P is sought to be inserted by the Finance Bill 2021 to provide relief to senior citizens. Friends, as I see this section, I see many more taxpayers will be pushed to this kind of tax compliance in the days to come. Section 194P is meant for senior citizens being pensioners aged 75 years and above, who have only pension income and interest income. And if they give declaration with the banker, the bank will take care of the total income and see relief under deduction under chapter 6A, relief rebate under section 87A, and it will deduct tax at source. When the tax is deducted at source, such person need not file ITR. So you see the conditions. He must be more than 75 years, and he must have only pension income and interest income, and he must not have any other income. Such interest income is also bank interest, and he must give a declaration to the bank. The bank will take note of his income, deduction under chapter 6A, and it will take note of rebate under 87A, deduct tax at source, and he need not file the return. This may be applicable only to limited number of taxpayers. It may not be applicable to many. But what I see is that this can be a prelude for what is going to follow. Slowly, the banks who are dispersing pension will become a sort of a mini income tax officer, and they will start taking, next year they may say all senior citizens above 60 years. So senior citizens 60 years to 75 years, they will also go there. Subsequently, salaried people, when the salary is credited and if they are giving declaration to the bank, and if the nominal charge is debited with the help of software, bank branches will become mini tax return preparers. I see down the line in the next 10 years, many small micro units may be covered by this sort of return filing exercise being given to the bankers. Banks, they have no personal reason or conflict of interest. They will be aided with a robust software, and they will take declaration from the taxpayer. Small taxpayers like departmental stores, small time vendors, retail shops, who have, if they are mandated to maintain single bank account, and if they are able to give exceptions to bank account, say gift of money received from somebody, gift of money given to some relative. So exceptions, if they are able to map and give it to the bank, and the day is not far off that huge crowd of marginal taxpayers will be out of our net, and our fraternity will have to see only the big players, those who are doing huge turnover. That also, if the taxpayers are tamed to follow digital transactions like 44AB, it may so happen that the digital transactions will come into play, and if they have less than 5%, it would become easier for them to comply with the legal provision. This 194P may be a trailer for the main pictures which may follow in some more years to come. This is what I look upon, because once the bank is found to be efficient for filing, taking the declaration and collecting the tax, and allowing the senior citizen to have hassle-free tax compliance, senior citizens above 75 years of age, to have hassle-free tax compliance, why not push the senior citizen, all senior citizens into that subsequently, then put all micro units into that subsequently. This can happen. The next one is TDS on purchase of goods. This is a very interesting amendment, which is just the opposite page of section 206(1)(h). We saw section 206(1)(h) meant for collection of tax at source, where a person having a turnover about 10 crores in the preceding financial year, immediately preceding financial year or previous year, does a turnover to any person above 50 lakhs of rupees. When he collects the money, he will collect 0.1%. Because of COVID, it has been made to 0.075%. This is 206(1)(h). Now section 194Q is corollary. It is to purchaser, a purchaser of goods. When he has the turnover exceeding 10 crores in the immediately preceding previous year or financial year, when he is purchasing goods from somebody exceeding 50 lakh rupees, he can withhold 0.1% and remit the money as TDS under section 194Q. The purpose of TDS is to create a trail. Once it is created, both the buyer and seller fall within 26 years. This information can be used by the department for seeing compliance, whether the person has filed his ITR or not. So TDS is one yearly collection of meager amount of tax without paining the payer or the deductor, whatever it is, at the same time creating a trail whereby with sophisticated technology in place, the revenue can always have recourse to it and ask what has happened. Have you filed your ITR or not? This section says when you buy goods, you deduct 0.1%. 206(1)H says you collect 0.1% when you have sold the goods to somebody above 50 lakhs. But one difference is 194H is applicable the moment you buy goods. 206(1)H is applicable only when you get the money. This 194Q is on due basis, on accrual basis, whereas 206(1)H is on receipt basis. If you don't receive money, you cannot collect TCS. Whereas 194Q is you have to, the moment you credit the supplier's account, you are liable to deduct tax at source at 0.1% and remit the money. So this is the distinction between the two. But unfortunately, the section I perceived like this, both the sections operate in the same field. So I thought it can operate for both of them. For example, I am doing a turnover of 10 crore. I buy goods from somebody for 60 lakhs and the person selling the goods has done a turnover of more than 10 crore in the preceding year, and both of us are now transacting for 60 lakhs. So when he is collecting, he will collect on that 10 lakhs, 0.1% being 1,000 rupees. He will collect as TCS. As a buyer, I will withhold same 1,000 rupees and pay the balance. So both of us will file. This is what I perceived. But the section, there is no mention in the section. But in the memorandum explaining the provision, it is stated where both section 206(1)H and 206(1)H and 194Q are applicable, then 194Q will apply and 206(1)H will give way for 194Q. But unfortunately, the legal provision does not contain that clarity. This is what I wanted to say. Because the legal provision should say, not the memorandum or the notes on clauses amending the legal provisions. But there can be, you can say, you can visualize 3 instances. A person, say for example, I am doing turnover of 11 crore in the previous year, preceding financial year. I have done a turnover of 11 crores and I am selling goods to somebody who has done a turnover of only 5 crores. And I am selling for 60 lakhs. So I am covered by 206(1)H. Since that person is less than 10 crores, he is not hit by 194Q. He will pay that 0.1%. Just to reverse the role, he has done a turnover of more than 10 crores, say 11 crores. I am doing a turnover of only 6 crores. In such case, he is buying from me and he need not deduct tax at source. Because he has to deduct tax at source, and I need not collect tax at source. There can be instances where both the buyer and the seller have more than 10 crores turnover in the preceding financial year, in which case the overlapping will be there, 194Q and 206(1)H. In such case, it is stated in the notes or memorandum explaining the provision that section 194Q will prevail, not 206(1)H. But in my opinion, this has to be given by way of a proviso. Why proviso? A proviso, the function of a proviso is to carve out an exception. They have stated it is an exception. When they have said it is an exception, it is the drafting. The draftsman should introduce only a proviso, so to say, in section 194Q and also in 206(1)H, where both the provisions are applicable, section 194Q will apply. I think it is a fit case for inserting a proviso in the legal provision. Then enhanced rate of TDS. See, 0.1% is the amount of tax deductible at source while making on the payments made to purchase of goods. It is not on payment basis, it is on due basis. Whether it is paid or not, the moment you make a purchase from a person for 60 lakhs, for the 10 lakhs, the amount exceeding 50 lakhs, we have to make an entry debiting the supplier, crediting the TDS payable. Now, if that supplier has not given TDS, for this, section 206AA is subjected to a small amendment to say you have to deduct tax at source at 5%, not at 0.1%. But friends, I am amused that they have given this 5% where the PAN is not given. Can a person make a supply to another person exceeding 50 lakhs unless it is an exempted goods under GST? I think when the supply is made for more than 50 lakhs to one person, will he not have PAN? So I think this provision is only as a matter of caution to provide for enhanced rate of TDS at 5% instead of 0.1% when the supplier has not given PAN. Next one is higher rate of TDS for non-filers. See, the government in the last few years has been tracking the non-filers. We have come across so many cases where the banks have not deducted tax at source on the fixed deposits. On the wrong premise, the taxpayer has given a declaration. There are instances where the bank has deducted TDS and the taxpayer, instead of complying with the legal provision by filing the return, thought fit not to file the return at all, let the liability be limited to 10% of TDS. These taxpayers or the potential taxpayers are called as non-filers. When the non-filers are found, who is a non-filer? A non-filer is a person who has not filed the return for preceding 2 assessment years preceding the previous year in which the TDS is attracted. So, this non-filers, in such of those cases, the higher rate of TDS is prescribed. What is the higher rate of TDS? It is twice the rate of tax specified in the relevant provision of the Act. Second, twice the rate of tax in force. Third, rate of 5%. Friends, this expression you find in section 206AA, these 3 expressions, rates of tax specified in the relevant provision of the Act, twice the rate of tax or rates in force, or the rate, some rate. Just I thought for any youngster who wants to have light to be thrown on this expression, the point is the rate specified in the relevant provision of the Act means in the specific provision itself. For example, section 194A 10%, 194H 5%, 194C 1%, 194J 10%. This is the rate specified in the relevant provision. Rates in force. What is the rate? Meaning of the term rates in force, which means after the Act, you will find every year a Finance Act. In the Finance Act, they are giving rates in force. That rates in force will be applicable. The third one is rate of 5%. So higher of the 3. So twice the rate of tax specified. Then twice the rates in force at the rate of 5%. If a person to whom tax is deductible under section 194Q, he has not filed a return for the preceding 2 assessment years and for which the time for filing the return under section 139(1) has expired. In such case, you have to deduct twice the rate of tax given in the section or twice the rate given in the Finance Act or 5%. The next one is 206 CCA. This is with regard to TCS. Here also, where the tax is collectible at source and the person has not filed the return for the preceding 2 assessment years and the TCS tax deductible or tax collectible is there. He is a non-filer. In such cases, we have to deduct tax at source at twice the rate specified in the relevant provision of the Act or at the rate of 5%. So this is to penalize the non-filers. This is independent of the department having recourse to initiating proceedings to make them file the return and comply with the provisions of law. The next one is Settlement Commission. We all know Settlement Commission as applicable mostly when the case is complicated, which is found most of the times after search under section 132 or requisitioned under section 132A. We all know Settlement Commission is a very lengthy procedure where we have to disclose the facts of the case, and it is a sort of an arbitration. Here the government thought Settlement Commission is not required, and therefore no further explanation for settlement of the case could be filed after 1st February 2021, and whatever applications which have been filed and admitted by the Settlement Commission, that only will be adjudicated and completed. Even the option is given to the taxpayers to withdraw their application. The time limit is 3 months from the date of coming into force of the Finance Act 2021. So if somebody has filed application before Settlement Commission, now after the Finance Act comes into force, if he feels that it would be better not to go for settlement, he can withdraw the application. The next one is Dispute Resolution Committee. This is a very interesting approach adopted by the government to have Dispute Resolution Committee by inserting section 245M. This is applicable only in limited cases where the assessee has addition less than 10 lakhs in the assessment. See, in the case of non-residents and foreign companies and Indian residents where there is a transfer pricing adjustment with reference to TPO, there is addition to the income returned by determining the arm's length price, dispute resolution panel is there, which is section 144C. Now, Dispute Resolution Committee is a new addition to the tax legislation in India, where the assessee can seek dispute resolution committee if the income returned is less than 50 lakhs and the addition proposed in the assessment is less than 10 lakhs. He can make an application and dispute resolution committee will decide. Even that is not binding, like a dispute resolution panel, dispute resolution committee, whatever it decides, still the taxpayer is having the privilege to dispute the assessment in the appellate forum. But this is a good mechanism where the addition made is less than 10 lakhs and the income returned is less than 50 lakhs. The dispute resolution committee can be invoked by the taxpayer. It is optional. Next is Board for Advance Ruling. Board for Advance Ruling, we all know authority for advance ruling is meant for residents when they are having transaction with foreign companies, and for foreign companies when they are going to undertake some transaction with residents in India. This advance ruling, the government observed, it has not been that active. Advance ruling has not been active, and advance ruling, even if it is given, it has only persuasive value as regards the taxpayer. Once an advance ruling gives a decision, it is binding on the department, even the commissioner. But so far as the taxpayer is concerned, when he is not getting the advance ruling to his liking or in his favor, he can always challenge the advance ruling by making an appeal before the High Court. Therefore, the advance ruling, whatever it decides, is only having persuasive value so far as the taxpayer is concerned and has no binding force. But what the government thought, they will come out with board for advance ruling and they will constitute more boards in the rank of a chief commissioner to decide the advance ruling mechanism. The next one is faceless ITAT. We all know, as practicing chartered accountant, we have taken all measures to face the assessing authority. The income tax authorities in section 119, whoever is stated, we have seen all of them. In the original assessment, we have given all the details, we have confronted with their findings, and we have gone for first appeal, where the commissioner appeals who can enhance the assessment, and he can either decide the case in favor of the assessee or in favor of the revenue, and the powers of the commissioner appeals are coterminous with that of the assessing officer. Now we have faceless appeal scheme. Commissioner appeals now is faceless appeal. We have to give replies, and the commissioner appeals, one or more commissioner appeals will look into it. We can contest their finding. They will give a draft order, and they will take the services of National E-Assessment Center or Faceless Assessment Center, and they will take the service of the assessing officer as well. Now, the commissioner appeals has a lot of rigidities. You cannot give new grounds. If the assessing officer is going to object, we cannot say I will give new grounds. You cannot give fresh evidence. Rule 46A. If you want to invoke 46A, the original assessing authority will have the right to say whether the fresh grounds, that additional evidence is to be entertained or not. Then they can comment on that. But everything is faceless. Then beyond that, the commissioner appeals, when he is making a high-pitched addition, definitely it will go to review unit at that level, not review unit of assessment. Review unit in appellate level, it will go for review. In other cases, a show cause notice will be issued, the assessee can give his objection. Now we are going to see faceless ITAT. Friends, one of the excellent reforms brought out in tax administration in the recent times is any authorized representative or taxpayer, if he is factually correct, he can be fearless. He can contest the assessment. He can go to any forum because it is faceless. He must have some attributes. What attributes? One, stating the facts in simple language with clarity and the energy to provide the details. I come across cases where in faceless assessment, the assessment unit asking for all the vouchers to be scanned and sent. But if you have the energy to provide the information, even I have come across cases where the assessees are asked to give the entire books of account. If you are able to find a way out to provide the books of account, and if your books of account are proper, if you are able to scan the books of account before you give, of course this is personal, it's not official, I can say. If you are able to present the facts without any difficulty, I think the faceless assessment, right from assessment to appeal or ITAT, you need not have the tag of what you were or what you are as of now. If you are able to present facts, ITAT will also be entertaining, and any person from any nook and corner of this country, if he has the energy and attitude to present the facts properly and have adequate grounds, faceless ITAT is being proposed. It is a very path-breaking change, because I was under the impression, in fact, ITAT comes in the domain of Ministry of Law and Justice, and it may take some time for them to bring the faceless ITAT. But I am glad that they have brought faceless ITAT in this bill itself. And in the days to come, any person anywhere, if he is good in interpreting the law and if he is able to elucidate the legal provisions and explain to the other side of the table in the proper way, it can be represented, and a flawless language, a clear presentation of facts, of course, genuine cases. I think we have a very good face to win in the faceless assessment, faceless appeal, and faceless ITAT. The last and final one is provisional attachment to protect revenue. We all know the tax officers during the course of assessment resort to attachment of property. Even they can also withhold the refund. But now, what is sought to be done in this finance bill 2021 is that, section 271 AAD. In fact, a circular had come where fake invoices, fake accounting entries made by the assessee and any person who is abetting such crime shall be subjected to equivalent penalty. For example, a person is not making entry of purchases of 1 crore and the seller is also not making entry of 1 crore. If it comes to light, in whatever way it is possible, if both of them can be punished to the extent of 1 crore. This is what fake invoices. And such of those cases where 271 AAD is proposed to be initiated, before conclusion of that proceedings, penalty proceedings, it may so happen the assessee may transfer the asset and get away from payment of penalty. To block that, the Finance Bill 2021 proposes to insert and amend section 281B, whereby a provisional attachment for a period of 6 months is possible, so that the taxpayer cannot deceive the exchequer by transferring the property or by any other dubious means. I think I have had just a roundup of all legal provisions, but I have not gone to more so in the realm of international taxation, for the simple reason that we should first be abreast with what is required for our day-to-day practice, and the international taxation for that matter is not a regular feature in our daily routine. So such of those cases, I thought I will not take it up, though there are some interesting like liability to pay tax, then dividend, then MAT provisions. These are not necessarily international, maybe more in the tone of corporate taxation. But I thought whatever I have covered is appropriate to set the discussion. And I'm very happy that both the branches were so kind enough to give me the opportunity to reread and learn. And I'm sure as I was presenting this highlights of amendments, I am also getting enlightened with many more changes which will unravel in our mind in due course of time. With this, I conclude my presentation and I request the floor for any interactive discussion. In fact, I know there are many enlightened senior members in the profession who have better experience, better exposure, and better knowledge. It will be mutually enlightening if they can give some more inputs to whatever little I have shared with them. And if any member has benefited from this presentation, for that also I am very thankful. With this, I hand over the proceedings to Chairman of Erode branch and Pondicherry branch to continue the deliberation. Thank you very much.
Thank you so much, sir. Such a deep and wonderful presentation, and also deep explanation about our budget 2021. Here, session hand over to sir. Can I take the question answer session for a few minutes?
You have to ask the next faculty, sir. He's waiting.
Yes, sir. Srinivasan, sir, if you don't mind, can I get 5 minutes of time for a
question? Absolutely, sir. Absolutely.
Thank you, sir. Thank you for your kind. Members, here is a request to put a question through a chat box or a raise your hand. I will unmute you for budget 2021 direct taxes.
If there are no questions, two possibilities are there. I do not know where do I fall.
Sir, we already got one messages from Mr. Shanmuganathan, sir. Sir, can I read it?
Please.
Sir, in section 206C, subsection 1 second provision states that the subsection shall not apply if the buyer is liable to deduct TDS on the goods purchased. So I think CS will not applicable in this case. I think this is the case in which we discussed for 194Q. At the time we get the message, sir. I think so.
206C.
Yeah, maybe, sir.
206C, I don't find any amendment in section 206C, sir. I see amendment in section 206AA, 206AB, 206. Sir, can you read once again, sir?
Yes, sir. Sir, in section 206C, subsection 1H, second provision state that this subsection, this means I think that is 194Q, sir, shall not apply if the buyer is liable to deduct TDS on goods purchased. So I think TCS will not applicable in this case.
Have they 206C subsection 1? Subsection 1, sir?
Catch, sir.
1H, okay.
Second provision states that.
Second proviso.
Yes, sir.
Shall not apply if the buyer is liable to deduct tax at source under any other provision of this act on the goods purchased by him from the seller. I agree with him, sir. He is correct, sir.
Yes, sir. At the time of 194Q discussion, he delivered.
Yes, yes. Good, sir. Good, sir. Valid point, sir.
Fine, sir. Members, I requested to you, any question is there, kindly put your chat box or raise your hands. I will unmute you. Seems there is no question, sir. So such level of explanation from your side. So much of happy with you, sir.
Thank you. Thank you. I take it as compliment.
Floor is hand over to Pondicherry branch, sir. Kritika ma'am, kindly take care of it.
So good evening, sir. Thank you, V.K.Subramani, sir, for the first session of our today's seminar.
Thank you, ma'am. Thanks for the opportunity to both the branches.
Yes, sir. Thank you, sir. It's my pleasure to welcome the second speaker, T.R. Srinivasan from Chennai, for today's seminar on Union Budget 2021. I welcome you on behalf of both the branch. T.R. Srinivasan is a fellow member of ICAI. He is presently the partner at Mrs. N.V. Balaji & Co. Chartered Accountant from Chennai and is headed their GST and Risk Advisory Division. He is a member of the study group for implementation of GST of ICAI. He is a certified trainer of NASIN, Government of India for GST. He is a faculty on the subject of indirect taxation and financial reporting for the past 10 years. He trained more than 5,000 officers of Income Tax Office and GST Department as a visiting faculty at the Regional Training Institute and the Comptroller and Auditor General of India. He is a speaker at various trade associations and Chamber of Commerce. He addressed various schools and colleges on commerce as a challenging career option. With these few words, I introduce to this webinar, sir. Thank you, sir.
Thank you, madam. Thank you for the introduction. And also thank you to the Pondicherry branch, Srimati Kritika, and Erode branch, Sri Balamurugan sir, and also my regards to my co-speaker, C.A. Subramani sir, and also to all the members of the Pondicherry and Erode branch who are present here, and to the fellow members. The topic given to me is, a quite simple one, which is about changes in indirect taxation as regards this budget is concerned. Most of us, of course, is aware that any changes in GST cannot be introduced through Finance Act. Normally, it has been done or can be done only through a recommendation from GST Council. And also on top of that, only the GST Council can give a consent, and pursuant to that only, that the past history is that it can be brought only as a separate ordinance by way of an amendment in the respective law. However, Finance Act is normally used as a tool to make an amendment to a parliamentary law, which is CGST Act. So the government has proposed certain changes, which also shows the intentions. That is one thing. And of course, we can see a lot of changes happened in customs matters. A lot of phasing out happened. Broadly, to sum it up, there are two things I will have to say. One is that there are a lot of discretionary powers which has been vested now with the officers, especially on the GST side. What was all on more of a trade facilitation measure, now it looks like a little more stringent discretionary powers. If it is a directionary power, it's different, but it's a discretionary power. A little bit has been enhanced on the officers side. So that is something which we could see out of the GST amendments. And let me just quickly run through the key amendments and what we should take care. And one of the key things we need to look at is what are the upcoming areas as a professional in customs matter. There are some good opportunities or as a professional to advise on the customs matters or even on the foreign trade policy, which we'll also discuss it as part of the amendments which we have. Right. So, Madam, do you have the power to share? Yeah. Thank you. Yes. Fine. So the first set of amendments, which is broadly related to the GST, most of us will be aware of certain popular amendments, but the key highlights has been that there are certain procedures. Of course, one thing which has been quite often discussed, one of us know, is that GST audit is not required. And of course, government has clarified that financial year 1920 it will be applicable. Only this provision of GST audit will not be applicable. This provision could be effective only from the date notified later point in time, because as such the central government cannot notify the effective date unless the respective state governments also correspondingly pass this enactment or changes. So unless the state governments agree and possibly in the next council meeting they may enforce this one. So it could be possibly from 2020-21 onwards the GST audit may not be required. Of course, it doesn't mean that it's lost. There is a self-certified annual returns the taxpayers have to file. So the moment the self-certified taxpayers self-certified annual returns has to be filed, it also comes with a reconciliation statement. Of course, the auditor's signature would not be required for the same. One of the key reasons which has been made out, in fact, that is also one of the reasons why ICAI started collecting annual returns liability as well as audit liability as part of the Udin generation. They also used to started collecting last year about how much liability was discharged through the annual returns and how much liability was discharged through 9C. It was also asked. That is because of one of the observations made in the GST Council minutes also. When they enhanced the limit from 2 crores to 5 crore for GST audit, one of the justification given was the total collections out of the GST annual returns is about 3,100 crores and annual return 9C is about some 300-400 crores. So roughly 3,500 to 3,600 crores is the collections made. And when the council said 9C was yielding only about 350 to 400 crores, suddenly, naturally, there was a reason that it should be waived off. But of course, little that the government realized that even the 3,100 plus crores, which the assessees have paid, is only out of the auditor's information. That is, it's that most of the cases in 9 itself, most of the amendments or corrections have been done. Hence, the auditor's recommendation paragraphs will be substantially lesser. So this is something which ICAI also would have or effectively would have projected it. But it is also one of the reasons why they started collecting from last year about Udin. When we generate itself, they were asking how much was discharged to 9, how much was discharged to 9C. So this is very key information which was asked. And of course, effectively one scope of opportunity as a CA, we feel has been lost. So now this, of course, this comes with certain other points. We can expect a shoot up of litigations going forward. So that is something which we may expect in the coming days. Right now, some of the key changes which are expected in GST, and I have to say most of these changes were done only to correct some mistakes in the law, or only to in fact rectify what the government thought. Basically, for example, let's say that Krishi Kalyansis cannot be carried forward. Like that, there was one intention of the government, but it was not there in the law. So the government amended the law itself retrospectively. So like that, there are some changes which were made in the Finance Act this time with respect to GST, which are to rectify the government intentions. So let me just quickly run through those amendments. One of the key amendment made is that, there was one Supreme Court decision in the old service tax law where they held that, supply of any goods or services by association, registered associations to its members is beyond the levy of service tax. This was the decision held up in the Supreme Court in a Calcutta Club Association. In that association, this decision was held. This came up somewhere in 2019. This decision was held by the Supreme Court. And because of that, what happened? So basically any registered association, it means it could be a housing association registered or a club association registered or chamber of commerce registered. If they are collecting money from the members, then it was not required to be subject to service tax. exactly same provisions were there in GST also. In fact, GST had a much lesser provision. And because GST had a much lesser impactful provision, the council itself observed in one of the minutes that associations cannot be brought to service tax as it stands today. That's how the GST as it stands today. Technically, till this amendment was proposed, the associations were not liable for GST. Why? Because there was no enabling provision in the law itself. There was only one provision which was there in schedule, and the schedule was saying that unincorporated association to its members could be deemed as a supply. But the schedule has no power when the primary section had no power at all. So what the government did, they brought an amendment in the law itself to mitigate or avoid that Supreme Court decision where they said that now any supply by a person other than an individual, it could be association of persons, it could be a club, so whoever it is, if they are supplying anything to its members. See, we all understand from beginning we thought it would be liable, but actually it's not, because Supreme Court also so somebody has not paid the tax till now, it is technically valid because there was no liability at all. So now the government has amended it, but however they have amended it now retrospectively from 1st July 2017, saying that association providing services to its members or even constituents. So when I say constituents, it need not be a member. It could be somebody, it could be a temporary member who came for a few days, etc. So that is also would be liable for GST. So that is the provision they have brought in. This is only to avoid. Now, when they brought the amendment, one of the key points is that they have started getting into the judgmental mode, in the sense that they said irrespective of anything contained, you can see that anything contained in any judgment also, they can say that this is what is liable. So this is something of a bureaucracy overreaching the powers of the judiciary. Of course, we can expect this to be challenged in the courts because constitution wise, there is no power to tax the incorporated association. So this is something which could be brought into litigations at a later point in time. So the government is aware of the litigation. So as it stands today, any association, the law has been amended legally now to say that any association providing goods or services to its members would be taxable, which was not there till date. So this is from the announced in the budget, but officially not yet notified. So this is the first major change they have done. The second major change, which is also a very valid point, it could also be something which is useful for us in future when notices are being issued, is on everybody knows that if you want to take input tax credit, the relevant invoice has to be present in our GSTR 2A. Now we call it as 2B, etc. So this is what we know. That means we know that there is a gap they give. That was from October 2019 to December 2019. They say 20% gap is allowed. That means if 2A is saying 100, you can take up to 120. Then from January till date, till December of last year, 2020, they said 10% gap is allowed. That is 2A to 3B, 10% variance is allowed. Now from January 2021, from this last month onwards, they said only 5% gap is allowed. That is 2A to 3B, 5% gap is allowed. And of course, we know where the direction is going. It will be from April, they will say it only what is available in 2A only you can avail. So this is what is going to happen the next few months. Now, this amendment, this provision is there only in the rule. Okay, there was no enabling section which gave power, to describe the manner of availment. See, how to avail, form can be there, procedure can be there, but restriction by way of percentage, the powers were not there in the law, and it has been challenged already in the many of the high courts. In fact, Madras High Court, there are quite a few petitions. Gujarat High Court, there are petitions challenging that rule 36 of rule 4, saying that matching is not, this matching concept is still not valid because there is no power in the law. Now, to correct this point, the government has made an amendment here. They said that in section, the matching provisions, they have made 16, that is the input tax credit rule. They now brought one rule which said that the government, central government is empowered to say that how much match credit is allowed or how much match credit is not allowed. So the powers has been given to the central government only after this amendment is made. So what that means, sir? It means anything which has happened till the past. And please remember, this was not a retrospective amendment. It is a prospective amendment. That is, it is applicable only for the future period after the notification comes into force. So technically, the government is also aware that the rule 36.4, which is talking about this matching, may not be legally tenable. That is the reason that they have brought this amendment, and this was also discussed in one of the council meeting. And after the recommendation only, they have brought this as one of the points here. So let's say if there is some taxpayer who has taken credit based on his valid invoices, he has not matched to 2A, but he has taken entire credit. Even if it was more than the 20% gap, he has taken that credit. Legally speaking, it could still be valid till this amendment comes into force, because there is no enabling provision in the law to match this. That is the reason the government has brought this amendment itself in the section itself. So possibly the rule 36 sub rule 4 could be struck off in the in the legal battle, which is already on. So if somebody has taken the credit without matching to 2A, it could still be valid. This is what we are trying to convey here, because one, the very purpose of bringing this restriction in the law is because of the enabling power not being there. Second, it is not a retrospective amendment. If it has to be retrospective, they would have made it clear in the the provision itself when they brought in. It's not a case. So for example, previous amendment was retrospective and it was brought from 1st July, whereas this amendment is not retrospective, and it is said that from such date as notified by the central government. So it means that there is a valid case. I would say if somebody is willing to, if some assessee taxpayer is willing to take that bite or risk, they can take the credit based on what is available with their invoices, not necessarily based on 2A. So this is what we wanted to convey here. And there is a fair case already in a lot of writ petitions being filed against 36(4), fair case that it could also be struck off in the coming days. So this is the second important point which we have to keep in mind. Possibly if you are getting a notice on 2A versus 3B mismatched, and you have taken credit more, of course till September 2019 there is absolutely no issue, because law itself was not there of matching. October 19 only rule came up, law was not there still of matching. And more importantly, they said based on supplier uploaded, we have to take the credit. Now supplier uploaded, if you have to take the credit, we will not know what supplier has uploaded. What we know is what is displaying in 2A, and 2A is not a valid document at all. 2A is not at all recognized anywhere in the law till date. Hence, this section is under challenge, and hence the government has brought this amendment to bring the concept of matching. And of course, there is a provision where this provision also says that that 10%, 20%, the gap which they're given, the central government has powers to eliminate this gap. It means that they can bring it to 100% also. So we can expect that from 1st of April 2020, it could 21. It could be only what is available in 2A, you may take the credit. So it is advisable that this point is brought to the notice of the taxpayers, and especially if somebody has taken 2A's huge gap is there, this provisions may be taken note of. This is the second important change which you have done. Third important change is quite obvious, that 9 and 9C has been, 9C is removed, 9 is still there, and we can expect that 9 is going to be amended to bring all the points in 9C. So whatever content is there in audit report will be brought in GSTR 9 itself. So still it will require the support of a chartered accountant or cost accountant to do the same. But however, of course, naturally the powers, statutory powers to certify has been taken away as regards this. This is also one of the learning for us as a professional, is that any dependency based on a government policy based audits is at risk. That's something which we have seen in the last few years also, especially with tax audit amendment also. So any dependency on the government for any statutory or tax audits is at heavy risk. And of course, that is something which we may have to also accept it. And maybe we have to look at how we position it in terms of value of audit rather than the statutory nature of it. So this is something which we will have to definitely take note of. The next major amendment is that one of the gap was, let's say we had some few cases where the taxpayer had cash balance, electronic cash balance was there, credit balance is not there. Let's say there was a cash balance of 1 lakh rupees in his account, and it was not adjusted. And during that month, there was a liability of 1,50,000 rupees. And the question is on which amount the interest has to be paid. If it was a credit balance, the law was amended to say that you pay only on the net amount. That is only on the 50,000 rupees you pay interest. Now, if it was a cash balance, there was an anomaly. It means that if it's a cash balance, you cannot adjust it. You have to pay on the gross value itself. The law was not modified. Now the law has been modified to say that if you had a cash balance in your electronic cash ledger and you have to still, you had a liability and there was a belated filing of GSTR 3B. Let's say January month, GSTR 3B was filed belatedly, let's say 15th of March. Now, if you had already cash balance, you deposited the cash, but it was not adjusted, that cash balance can be deducted while calculating interest. So they have given a basically relief to bring it on par with credit balance. So if you have electronic credit balance or you are claiming electronic credit or you already had a cash balance, that cash balance can be subtracted and after that only interest has to be calculated on the net balance. So this is a welcome measure, and we need to remember that this is applicable from 1st July, retrospectively it has been amended from 1st July 2017 onwards, it has been amended. It means that, so if any assessee, any taxpayer has got a notice saying that, you have to pay interest because, there was a liability and though there was a cash balance, you have to pay interest. That notice are all now invalid because of this amendment. And of course, this is going to be from retrospective effect. And if somebody has already paid the interest because of this issue, you can very much claim that as a refund as such. So that is the important amendment which has been made in this regard. And the fourth one, it's a massive power given to the officer. It's a very important power given to the officer. And this was in continuation to the powers which has given through recent amendments in rules. So one of the major amendment they have done is that if there is a difference between GSTR 1 and 3B. So normally we are aware that sometimes the taxpayer may not have cash, but his customer will insist that only if it reflects in GSTR 2 for me, I will release the money to you. So this is a practical problem we have. So what many of us advise is that, okay, file GSTR 1 with the actual, transactions. GSTR 3B, you are not able to file it, no problem. At least you file it later with interest. This is what we used to say, or at least you declare whatever it is and next month you can amend it. Okay, now the government has brought the enabling provisions in the law itself. So what is it they are saying? If there is a mismatch between 1 and 3B, the rule has been amended to say that there is a power for cancellation of registration. After the opportunity is being given, cancellation of registration can be given. That was given in the rule. Now the powers has been given in the law, which says that if there is a mismatch, then recovery proceedings can be initiated. That means your bank account can be attached. Then you can attach the property provisionally. So all the powers of section 79, which deals with recovery procedures, is also enabled. It means, effectively what they are saying is the self-assessed tax is not only what you are declaring in your 3B. So that is a technical amendment made. So because tax payable as per returns was the wordings used in section 75. Self-assessment tax is the tax payable as per returns. Now tax payable as per returns was as per 3B. Okay, so the tax payable as per 3B was, let's say, 1 lakh. You declared 1 lakh, that's the self-assessment tax, and there was no recovery mechanism for the difference between 1 and 3B. Let's say 1 was 1,50,000, 3B declared 1 lakh. Self-assessment tax was 1 lakh as per the definition. Now they modified, they enhanced the definition and said self-assessment tax is not only tax payable as per returns under section 39, which is 3B, but it also includes the difference between GSTR 1 and 3B. That's the amendment they made. So it means if there is a difference, then recovery procedure can be initiated. So that is the impact of that point. Now, please remember, this was an amendment made in section 75(12). So what does that mean is that, in fact, there are some cases. This was also there for interest calculation. The same provisions were there. At that time, what many officers used to do is they used to attach the property without issuing a attachment notice. So that was also one of the, because it was not mentioning about opportunity of being heard should be given. Like that wordings was not there in 75(12). And this was taken advantage by many officers when interest was not paid, when there was issue about net interest or gross interest. They used to attach the property without giving notice. And of course, it has been questioned in many of the high court decisions, but powers were exercised by the officers. Now, if there is a difference between 1 and 3B, that is also self-assessment tax, and that is also liable for attachment. So it means, we cannot just like that advise the taxpayer, okay, you, file it difference. And remember that if the difference could be also the entire amount, okay, which is not furnished in section 39. It means if the return itself is not furnished, entire amount will be a difference. and that might call for an attachment. So it could be a serious consequence involved here. So if there is a mismatch, please ensure that it is taken care immediately. And that is something which, or we may have to arrive at a practical solution on this particular matter. So this is a major amendment they made. Again, the scope of the officer has been enhanced in this case. And please remember, if it is an attachment issue, then it becomes a much serious consequence. Earlier it was only registration cancellation, opportunity of being heard, etc. So it's a procedural consequence which can be handled. I'm talking about even last 2 years, last 2 months. Now it is attachment is the next issue, which if it's significant, the powers of the officer is substantially enhanced here, and it could lead to a potential, reputation issue for the taxpayer also. Hence, when you advise on this matter, we need to be absolutely careful in this regard. The next one is about detention. So normally what we used to happen is when, detention happens, I'll just take this after next few points. One of the most important amendment they made is that, see, there's an order passed at the officer level. Now at the adjudicating authority level, they passed an order. Let's say there's an interest of, tax of 10 lakhs, penalty of 10 lakhs. They passed 100% penalty. When you go for appeals, what the law is very provision which is as of now, as the GST law is today, the provision is that you have to pay the percentage of pre-deposit, okay, which is normally when you go to appellate officer, first appellate authority, you have to pay 10%. So 10% of the tax. This is what the provision says. So I repeat, 10 lakhs tax, 10 lakhs penalty. 10% of the tax is what is a pre-deposit. Before you go for appeals, balance will be stayed. And if it was a case of only penalty, okay, as it stands today, there was no pre-deposit required because the law says 10% of the tax. That's the provision which is presently available as regards the penalty, appeal is concerned. Now, if this issue, if the order is passed arising out of a detention, like when the goods are in transit, it has been detained for non-carrying of documents like e-way or invoice or delivery challan, etc. If it could be as simple as DC is not there, etc. So in such cases, what they have brought in is that if you are going for appeals, okay, see, there are genuine cases like, delivery challan, there could be some mistakes in the numbers or values, etc. So in such cases, because the powers are exercised by the officers in the check post, etc., there could be very much possibility they may pass the order. So in such cases, when you're going for appeals, what the amendment has been done is that for the penalty portion, you have to pay 25% of the penalty portion as the pre-deposit. That means if the same example, 10 lakhs is the tax, 10 lakhs is the penalty. So on the 10 lakhs penalty, 25%, which is 2,50,000 rupees, has to be deposited as pre-deposit, and then only you can go for first appellate authority appeals. So this is a massive change which has happened. If it was pre-amendment, there is no pre-deposit on the penalty. There is only pre-deposit on the tax portion. And please remember, this we have to read along with an amendment made in penalty arising out of detention. So let me just pull both these points together. Now, pre-amendment, it's not yet notified, but this is something which we'll have to immediately escalate to all the taxpayers because it has a very serious impact. What is the impact? Pre-amendment, let's say there is a movement of goods, and the movement of goods is for the value of 50 lakhs. Tax involved is 18%. Now it was detained for lack of invoice or e-invoice or e-way bill or delivery challan, whatever you call it. It was not there. So it was detained. Now, you are detained. Now, what is the procedure is detention notice will be given. After detention notice is given, they will ask you whether you want to pay the tax, discharge the tax, etc. If you say, yes, I'll agree to pay the tax, matter ends that you pay the penalty over. Now, after that, they'll pass the, or if you are not agreeing to that, they'll issue show cause notice. You will have to reply and they'll pass the order. Then you have to go for appeals. That procedure will follow. Now, what is the impact presently? Pre-amendment scenario is 50 lakhs worth of goods, 9 lakhs is the tax, 100% is the penalty, which is another 9 lakhs. So 9 lakhs tax, 9 lakhs penalty. Now, please remember, there is no discretionary power with the officer. In the sense, he cannot say, no, okay, I levy penalty of only 5 lakhs. That power is not there. It's 100% tax and 100% penalty. And in so many judgments of detention, it has been made very clear that there is no arbitrary power of the officer. So 9 lakhs tax, 9 lakhs penalty is what he is going to charge. This is pre-amendment. Now, post-amendment, what they have done, so important change is that What the officer taxpayer used to do is that the 9 lakhs tax which we are paying pre-amendment, we will adjust it against our regular tax liability, monthly tax liability. Okay, it means what? The 9 lakhs is not our cost. It will be adjusted like advance tax. It will be adjusted whenever we are paying our regular monthly returns. The 9 lakhs penalty which we have paid, we might go for appeals. Okay, or we might be happy with what we have paid and move it on. Now, if we go for appeals, there was no requirement to pay pre-deposit. Why? Because the law was saying it is 10% of the tax. So there was no tax appealed against. I am only appealed against the penalty. So there's no need for pre-deposit itself. People used to go for appeals. So it was an easy mechanism. And now post the amendment, the impact is the provisions in the detentions also changed. What is the amendment is how much tax you are, so the same example, 9 lakhs is the tax impact, 9 lakhs is the penalty. This was pre. Post amendment is there is no tax. It means they are not going to demand tax. However, penalty is doubled. It means penalty is 200% of the tax payable. It means penalty will be 18 lakhs. So what you are paying as tax 9 lakhs plus penalty 9 lakhs has now been modified as penalty 18 lakhs straight away. 200% of the tax payable is the penalty. Then how much tax should I pay at the time of detention? Not required. So what you are going to pay at the time of detention of goods and any check post or on way in transit is penalty only, which is how much? 200%. So now the issue is very high, serious consequence. 200% penalty is going to be levied. Now, if 200% penalty is levied, okay, and you are not happy with that, you wanted to go for appeals. So the officer passes the order, you are going for appeals. When you are going for the appeals, pre-amendment, there was no pre-deposit because it was only on the tax portion. Now, post-amendment, they brought 25% of the penalty is considered to be the pre-deposit. So whenever it is a matter related to goods in transit and you wanted to go for appeals against that, you have to pay 25% of that penalty amount. The penalty amount is how much? 200% of the tax. So it means what? Let's say if 9 lakhs is the tax amount, your penalty is going to be 18 lakhs. On 18 lakhs, you are going to pay 25%, which is about 4.5 lakhs. It means 50% of your tax, the actual tax, 50% is going to be pre-deposit for going for appeals. So a huge, power. And you will see this impact coming in after the amendment is notified. This amendment is not yet notified. And of course, only when all the state governments notify, it can be brought into effect. And please note that the central government will not introduce an amendment like this without corresponding recommendation given from the GST Council. So this is a very impactful provision. Though the government's intentions could be to curb all the non-documentary movements, fake invoices, etc., it might lead to a potentially huge, risks if documents are not properly maintained. So this is something which we need to. So this requires a very strong documentation procedure for every taxpayer. Otherwise, they'll end up paying heavy penalty. So there's no tax component, and penalty is doubled, and appeal also you have to pay 25%. This is going to be a serious impact which is going to happen on this regard. So this is something. So this is in pursuance to that, whatever I told. So the amendment in section 129 is only on this point, which is basically earlier it was 100% the tax and applicable tax. Now it has become 200% of the tax payable will be the penalty. So this is what they have made a huge amendment. So this is something which we need to take care. And earlier, one of the issue is in detention, the procedure is they detain the goods. Okay, so we had one case. What happened in Hyderabad, they detained the goods. They gave a detention notice. The goods were detained, and after the undertaking given, they have been released. So BG they gave, or they gave a bond, bank guarantee they have given, and they have released the goods on the strength of the BG. But however, show cause notice is not issued, because if show cause notice is not issued, I cannot take it as an adjudication proceeding. They have to issue show cause notice. I have to make a reply, and they will pass the order, and then only I can go for appeals. If ever I want to contest it, my money was getting blocked at that point in time. So to avoid this practical issue, what the government has told is that if detention notice is issued, then within that 7 days, you have to go for a show cause notice has to be issued, and order has to be passed. So this is what, so they have brought in a time limit for issue of show cause notice after the detention, and also for passing the order after the detention and issue of show cause notice, they have brought this time limit of 7 days. So this is something which has been brought to ensure that the assessee may timely manner go for appeals. But however, this also comes with the side effect of higher penalty of 200%. So this is a important change which could affect the movement of goods, especially documentation is not properly maintained in this regard. And the next major issue, these are all the key provisions which are there in detention. And in case of confiscation of goods, the goods are confiscated. Earlier, the minimum fine is used to be about what will be the penalty will be the fine, and penalty sometimes it could be a general penalty of 10,000 rupees. To avoid it, now they said whenever there's a confiscation, there is no power left with the officer. Now it is actually 100% of the tax payable. Penalty will be 100% of the tax payable on the confiscated goods. So penalty is also 100% for confiscation. So which means imagine a scenario where there's a penalty for non-maintenance of goods. If the goods are confiscated, then there will be another penalty for release of goods. It will be 100% of the tax. So these are the multiple implications now. So the detention and confiscation is a very serious scenario. You may advise the taxpayers rightly on this matter to have proper documentation in place. Otherwise, day to day, we will face this problem. Another important change the government has brought in GST is that, see, for example, earlier the government used to collect record, the powers were vested with the commissioner to collect information from electricity department, to collect information from banks for statistics purposes. So when it is statistics purposes, it means that how much of money was discharged, how much of this taxpayer has done exports, how much money here he has laid. So basically, you can call for information about a taxpayer from a third party, but that is purely for statistical purposes. He cannot use this for his assessment. Now the amendment has been brought in. Okay, what is the amendment they have done? Any commissioner, jurisdictional commissioner. Now please remember, earlier it was on nomination, but now the amendment has been that any jurisdictional commissioner or any person authorized by him, it could be a superintendent or it could be a AC, JC, etc. They can issue notice to any third party. Let's say it's your supplier, customer, banks, electricity department, it could be your income tax department. They can call for the information after passing an order about you, and they can use it for assessment purposes. They said any purpose it can be used. So the entire, this was under section 151 of the GST Act. So earlier 151 is only more of a statistical information, means no action can be taken based on that. It is just for information, and whether that information can be shared with a third party or not is what they will check with the taxpayer. Now they have gone one step ahead. That information can be used, Form 26A's information, etc. They can directly call for. And that information can be used now to take assessment related proceedings also, after asking for an opportunity of being heard, being given to the taxpayer. Of course, the taxpayer will say it's valid, not valid, etc. This is because there are a lot of challenges which has come under service tax. Your clients also might have received a notice where service tax Form 26A, so much income is there, whereas in service tax returns you have declared lesser income. So please explain, or you will have to pay tax on that. However, there are enough judgments on this matter where they told Form 26A cannot be relied on as a valid document for the purpose of issuing notices. Okay, means you can't issue a show cause notice basis the Form 26A, because what you are giving is only a third party information that cannot be called for as a valid information. So this is, you can even question on what basis they are taking Form 26S, because there are judgments where accounting or tax disclosures could be different from GST or service tax disclosures. To mitigate that issue, Section 151 has now been amended to give a very substantive power where they can use those information, external information also, for the purpose of their adjudication after opportunity of being heard, being given to the taxpayer. So this is another massive amendment. So this also calls for a uniform disclosure and ensuring that reconciliation is being done. So this is also another point where reconciliation is important. So the taxpayer, just like that, cannot declare different information unless it has been matched and reconciled properly. So this is an important change which they have done. Enormous powers has been given on this regard. So all other things are substantially procedural, and the major, as I told you, is on the interest, on the liability, etc., and also on the powers enhanced for the officer, especially on the detention mode. So this is on, I would say, on the GST side, these are all the key amendments. Let me just quickly run through the customs related amendments also. There are few customs related amendments which are of importance or information which we should keep in mind, so that I'll just quickly run through the same on the customs related matters. Some of the key points in customs, I have to say, is that the government has tried to eliminate all exemptions substantially. And this is in line with their requirements for a Make in India scheme. They have, relaxed, or I would say they have made a lot of amendments in this regard. And before getting into the customs, because this is something related to export imports, I have to talk about one key amendment made in exports as regards GST is concerned also, which is amendment made in section 16 of the IGST Act, which is talking about two important points. The first important point is that if I supply to a special economic zone, let's say a chartered accountant providing services to SEZ, we used to say it is not liable for GST because it is a zero rated supply. We used to give some document called LUT online and we don't declare. Normal understanding is if I supply to SEZ, there was no GST. This we have to compare it with old law, service tax law. In service tax law, the provision is that if you supply to SEZ, we have to collect some document called form ARE1, ARE2, like that, few documents you have to collect. And if you don't collect that document, the department will come back on the supplier and demand service tax from them. It has happened in quite a few cases also. Now, post GST, what happened? When the law was brought in, point talked about should be authorized or non-authorized. Whereas in section, it was not there. So what happened? Let me give an example. So one of our cases, what happened? They are doing a daycare. They were providing daycare services to a SEZ unit for their employees' children. Now, this is technically not in the list of authorized operations as announced by the SEZ department. SEZ department has given list of 66 services, which are treated to be a default list of authorized operations, which is there in the websites also. So there are 66 services listed. In addition to the 66 services, if the SEZ unit is taking some new services, then they have to get a specific approval from the Development Commission of the SEZ. So if you have a taxpayer who is providing services or goods to a SEZ unit, and so first requirement is you cannot now say it is exempted or you cannot say it's zero rated. First thing the taxpayer should do is please give me whether this is part of your authorized operations or not. As I told you, there are 66 default services which most likely will cover substantial, but however there could be some services which are not specifically listed in the 66 default services. So if the taxpayer is providing a goods or service, I'll be give a specific example. Let's say the SEZ unit is having inside its one canteen. Okay, now you are doing a maintenance services for that canteen. What the SEZ law says is that canteen facility shall not enjoy the benefits which other SEZ units will enjoy. It means what? If you are doing maintenance of the SEZ building, eligible. If you are doing maintenance of the canteen facility, you are not eligible. So means that zero rating is not eligible. So it means it is the first responsibility to the taxpayer to ask whether my service is coming in your authorized list or not. Now, will it be same for all the services? As I told you, 66 services are same. In addition to that, every SEZ unit has to specifically ask for, other than those 66, if they want to cover anything, they have to make an application. Now, this has been now made important or amended. The law says only supplies to SEZ for authorized operations alone is covered. It means that every time when the supplier is making a supply, they have to get the authorized operation certificate from the SEZ unit, which should be endorsed by the specified officer of the SEZ. Otherwise, it cannot be said as exempted. It becomes taxable. So this is an important amendment. Though this seems to be a clarificatory amendment, this was an amendment in the law to rectify the mistakes. Another important issue on exports, which is not popularly discussed as our 9C audit issue, is that now exports, we have two options. We can pay GST and claim refund, or we can declare under LUT and not pay GST on export, but claim input tax refund. Now, these two options are left freely to all the taxpayers. You can either choose option 1 or option 2. With some restrictions, like if you are availing certain advance authorization license and all, you are not allowed. But otherwise, largely all taxpayers are given both the options. But now the powers has been given to the central government to restrict it. It means what? They can, the powers are now going to the central government to say that only certain class of taxpayers can go for payment of IGST on export and then claim refund. Because there are government's views that there are many number of fake refunds have been filed. People claim wrong refund. They go for IGST payment and claim the refund and they run away. On this ground, the government has brought an amendment in the section which says that central government shall now be empowered to notify class of persons who will be allowed to export on payment of IGST. So all those situations that you can pay IGST, claim refund within 7 days, etc. That was the original intentions. And that's how it has been going now also. Could be restricted, and it might be a big blow for some of the exporters where they are paying IGST, and because there are some exporters how they plan is some exports they do on payment of IGST, some exports they do without IGST just to liquidate that input tax credit. Now, if they are not coming under those class of persons notified, then they will land up in issues. So it means, especially because there are a lot of exporters who are classified as risky exporters, the government has brought this norm. So if you find any exporters having substantial credits accumulated, etc., you may advise them to go for IGST payment, at least till this budget amendment is notified. Okay, the budget amendment might be notified only after all states, bring this amendment and notified. So it can't happen at least in the next 1 month. So it will take at least next a few months to get it notified. So this is a major amendment made. So which means all people have to go back to the officers to go for ITC refund. Okay, this is the next provision which will come in. So though one way it's it might affect the working capital of the exporters. If you look at professional self-interest, okay, so there could be an additional claims which will be filed now under ITC refund scenario rather than going for export on payment of GST. So we are going to have who are those class of persons, etc. We might have the list later, but this will definitely be, so there'll be, again, we have to go back to the officer for supporting the documents and then claiming it, etc. So what the officer will do, he will say only 2A credit he will allow. So it means there will be again a lot of interactions which will start with the officer now on ITC refund scenario once this particular amendment is notified. So if somebody is having huge accumulation of credit, especially let's say capital goods credit, etc., they may look at payment of IGST on export and liquidate the credits before this amendment is notified. If otherwise, or you have to advise the taxpayers, if they have a plan, let's say to import capital goods after a few months, or let's say if there's a possibility of preponing it, it is advisable, because then the capital goods credit will be permanently blocked, because under ITC refund route, you cannot claim refund of the capital goods input tax credit. Hence, there could be a possibility of permanent blockage. So you may have to kind of advise this impact of this amendment to the taxpayers so that they can plan their businesses also accordingly. So this is another major amendment which has been brought in. Let me just quickly run through customs. I'll close it. I'll not take much of time. Madam, I'll take about 5 minutes to close it. So some of the key amendments made. So this slide is there, but most of the points I have to tell you is that all exemptions are getting waived. Another next 2 years, whatever conditional exemptions gave. For example, government has given an exemption if you are supplying for mega power projects. The government gives exemption if you have supplied for any competitive bidding, World Bank projects, etc. All those imports against conditional exemptions, like if you import for specific defense purposes exemption, etc. All those conditional exemptions are getting removed, and that is getting removed with a sunset clause of 2 years. It means what? If as on today there is an exemption, from here 2 years from the end of this year, it means by March 2023, all those conditional exemptions will be removed. So, and if anything comes after this, that also will be removed in the next 2 years. So government is eliminating exemptions for all the imports, conditional imports. And one major issue which I will have to tell is on bill of entry. This is something which we need to advise the taxpayer, is that if somebody is doing import, normally after import is done, you have a time limit of 3 days, 5 days to pay the duty, file the bill of entry and clear it. There is no late fee if you file a belated bill of entry up to 3 days. That is, you have an import today, from today 3 days, there is a time given for filing the bill of entry. Now the amendment has been made to say when the goods are, let's say, are going to arrive today, you should file the bill of entry by yesterday night. That's it. So it means you have to file an advance bill of entry preceding the date of arrival of the goods. Okay, so and what is called date of arrival of goods is something which could be disputed, whether it is entering the customs frontiers or whether it is actual unloading. But assuming it's an actual unloading, before before the ship arrives today, yesterday bill of entry should be filed. Now, what if I don't file it? If there is a late filing, every day there is a late fee of 5,000 rupees for 3 days. And if there's a delay more than 3 days, there's a 10,000 rupees per day late fee is there. And please remember, it is already there. It's not there after this amendment. It's already there. Earlier, there was a 3 days cushion was there, within which you can file a bill of entry. Now that is also lost. You should file before. One of the reason given by the government is that it will expedite unnecessary demurrage or unnecessary delay at the customs port. It will make it faster. So this is one of the reasons which has been indicated for the same. First important change. Second important change which has been brought in is that if you claim wrong input tax credit and you go for refund under customs, then you will be penalty will be equivalent to 5 times of the refund claimed. Okay, so if such refund is wrongly claimed, then you will have to go for 100%. I mean 5 times 500% will be your penalty for wrong claiming of refund under customs law. Okay, this is the second important point. Third, they are launching a uniform portal, single portal like GST portal for filing amendments, shipping bills, amendments, etc. Third important point. And the last important point is on Make in India initiative. The government has told if you are importing into India for job work and then it's going to be re-exported. When you import into India for job work, you are required to pay the customs duty. However, and when you are re-exporting it, you can claim back the customs duty paid as refund, like drawback. But that comes with some reduction. Now the government has told that if it is imported for job work purposes and re-export is going to happen after the completion of the finished product, you are not required to pay customs duty. So that will encourage more of, though it's not manufactured in, product is not manufactured in India, this will lead to a impact of, better compliance. I mean, job work is now encouraged in India. You can also import capital goods. And one of the important point is if you import capital goods, I use the capital goods and then I export the capital goods after the usage, I have to pay 100% customs duty and 100% value. Now they said on capital goods, you are eligible for depreciation and balance value only. You are required to do the liability of customs duty. So this is a major change for Make in India initiative. They have brought this point. So these are some of the key changes they have brought. And there are, of course, changes made based on industries. That is something which we will take it up. Something which will share it. You can refer to that. One last point is that they have brought in agricultural infrastructure development cess, AIDC, which is going to be added, and on top of that only we are going to add social welfare surcharge. So there's a new cess which is going to be levied. And on petrol diesel, the government has clarified that cess will be compensated by reduction in basic customs duty. But in all other imports specified, they are going to be having AIDC, additional infrastructure and development cess. And please remember, the government has brought substantial changes in the tariff, especially in tariff changes. They have brought a lot of amendments. They have hiked, percentage. So automobile parts, electronic sector, and IT sectors, like you are looking at information technology sector and all the telecom sectors, they have hiked the rates, and whatever was exempt now becoming taxable. Whatever was at a 10% rate has been enhanced to 15% rate. So you'll find increase in auto parts, IT, telecom, all these are becoming costlier because of the government's approaches to encourage more of domestic production. That is the reason in which they have brought, especially mobile components has been enhanced. You can see 10 to 15% enhancement has been done on all the automobile parts. They've enhanced the rates to encourage domestic provisioning. Now, in this context, I would like to just touch upon one small point before we conclude, is the government's scheme. They have introduced, most of you, or at least some of you must be aware of a new scheme the government has brought in 2019 October, which is related to something called bonded manufacturing facility. Okay, we call it as manufacturing and other operations rules. This is the new scheme which I brought in. Most of you must be aware of something called bonded warehouse, which is already, that's an age-old provision, which is a very tough procedure. Now, the government has relaxed it and they have brought something called as a bonded manufacturing. Okay, what is the difference is, earlier when you import, you can just import, store the goods in the warehouse. When you are clearing the goods from the warehouse for further manufacturing, you have to pay duty. Now the amendment brought is that the rules have been amended, relaxed. What they have told now is that you can import, you can keep it in your factory, you manufacture the finished product, and when you're selling the finished product, at that time you pay the customs duty which you have not paid at the time of your original imports. It means, should I pay interest? Not required. It means that the importer is going to save a huge amount on the working capital, especially if it's a major importer. Okay, this is something which you may advise them on the concept of bonded manufacturing. This is a new professional opportunity also. Somebody who is into substantial imports is done, whether they are re-exporting it or domestically selling it. If they are re-exporting, there is no duty through the entire supply chain because they are going to re-export, there are also no duty. If they are importing it, they are selling it domestically. When they sell the FG, only at that time they have to pay the duty. So let me take an example. Let's say there's a working capital of 3 months. It means I buy raw material day 0 and I manufacture the finished product. I store it and I sell it. So it takes, let's say, 3 months time. So for 3 months, there is no need for me to pay customs duty on this import of raw material, and I'll pay only after 3 months. This will be a huge working capital savings for somebody who is into a into more of a imports. So considering the fact that the government has enhanced the customs duty for many of the products, including mobile manufacturing, etc. So if somebody is a major importer, you may advise them on this scheme of bonded manufacturing facility. And please remember, it's not bonded warehouse, it's a bonded manufacturing. So entire factory will be bonded as a facility. And I have to tell, it's a very, very recent phenomena in the sense that though it is brought in 2019, only 2020, we are looking at a substantial demand for this. And Commissioner at Trichy and Kadalur and Chennai has been actively involved in doing this. If somebody who's into a major importer, you may advise them on this concept of bonded manufacturing facility, which is also a potential professional opportunity you may look at along with this point. And of course, in customs also, they have brought in faceless assessment 2020 itself. And in this context, there is another scheme I don't want to touch upon more. These are the two things as a professional you may look at as an opportunity of another scheme called AEO, Authorized Economic Operator. There's another scheme. It's like a status given. So these are the two schemes, bonded manufacturing and AEO, which the government has brought in and they wanted to push it quite extensively, considering India is now being treated as a global hub for manufacturing. I mean, India wants to be positioned as, even if they import, they want to import, manufacture here and export. So in that context only, they have brought this concept of AEO and bonded manufacturing facility. This is something which you may advise the taxpayers, and there could be a potential professional opportunity on this matter. So overall, this budget, primary focus in GST has been to give more powers to the department and take away some small points for the auditors. But definitely we will have more litigations coming in going forward in this matter. And of course, there are some professional opportunities in custom side, which I would request as a professional we would like to explore, because that is something which is an unexplored area for a chartered accountant. Considering the tariff changes and so many different schemes the government has introduced, I would request you to explore customs matters also quite extensively. So on this note, I'll conclude my session. Thank you so much for the opportunity to present myself. Thank you.
Thank you, sir. Thank you for a detailed explanation on the budget with respect to indirect tax.
Thank you, madam. Thank you so much.
Sir, we just have some questions in our chat box.
Yeah.
A doubt regarding filing of annual return for the financial year 18-19. Whether late fee will be reviewed to a notice of voluntary filing of GSTR 9 for the supplier whose turnover is less than 2 crores. However, based on the provision of the Act, filing of annual return for the supplier having a turnover less than 2 crore is optional.
Yeah. So once the filing of returns is optional, what is the provision is that if you have filed it within time, I mean before time, it's well and good. If you are not filed it within time, the return is deemed to have been filed on the due date of filing annual return. So there's a specific provision which says if your annual returns is optional, the law is not saying that it's optional. It doesn't leave there. It says that your annual return is deemed to have been filed on the due date of filing annual return. So even if you're filing it later, you would have deemed to have been filed on the due date because of specific provision in the law, and hence late fee will not apply in that case. So there's no late fee in that regard. So you can avoid late fee for the same.
Yes, sir. The second question is bonded manufacturing, you told about like 5 minutes before bonded warehouse. So
Yeah.
on manufacturing, whether this is a new provision, sir?
Is it a?
New provision? New?
Actually, this has come up in October 2019.
Okay, sir.
1.5 years old. But having said that, after October 19, there were no clarifications. The government issued clarifications in March 2020.
Okay.
That you have the COVID scenario. So it means that effectively for the last 1 year and 3 months, it has not been used by any of the industry. In fact, in industry, I would say only 1% in Tamil Nadu has obtained that scheme, and many people have now only started applying for it. So largely, it is in the very, very early stages of its applicability. And there are, especially because of the increase in the rates, etc. This has become more important considering the working capital scenario. So as professionals, we have ripe opportunities on this matter.
Yes, sir. Yes, sir. Thank you, sir. So if any members want to ask any questions, they can unmute themselves and they can ask the question.
Sir, this is Mohanraj from Karur. Hello.
Yes, sir.
Please go ahead.
Sir, you told me that bonded manufacturing.
Yeah.
For that, only for manufacturers, it's available, or for traders also it's available?
See, for traders, you can go only for bonded warehouse. In fact, the provision is given for warehouse come manufacturing. That's how they have given.
Okay.
So if you are going only for warehouse, you can go for it. I mean, it is because in warehouse, the only point is that you're just going to buy. So the facility is given for warehouse come manufacturing. And there are 2 licenses given. One license is for warehouse, another license is for manufacturing. If somebody wishes to go only for, license for warehouse, it is also open to you. So you can do that.
Okay. Okay. Thank you, sir.
The primary purpose is to encourage more of, Indian manufacturing. So in that context, they have.
Okay. Okay. Thank you.
Because that is a new we are just hearing new things regarding this bonded manufacturing. So we have more questions on that.
Yeah, and of course, for
benefit to the manufacturer.
Correct. And also for traders, there is a status. Some of the traders are aware, and many of the traders are not aware. Especially considering there's a faceless, assessment. What's happening is that you are, exposed to someday imports is happening in Chennai. The actual assessment might be happening in Delhi or Bombay, etc. Presently, practically what's happening, it comes with the officer name. So what typically happens is the customs guys go and reach that guy offline, etc. is happening. But, if you are an AEO, like it's like a tag, just like ACA, FCA. If you're an FCA, people assume that you have a better experience. Okay, the same way, if the importer is having an AEO status, then the rigors of faceless assessment is substantially less. Okay, so it means, especially in the context of a faceless assessment, if you are coming with the tag of AEO, authorized economic operator, your assessment proceedings are a lot simplified. Now, I have to tell you the fact, per import, the cost of import, let's say 20,000-25,000 rupees. If you are an AEO, the cost of import might be about 3,000-4,000 rupees, and the clearance is much faster, and that has been proven record. So my suggestion is that if you have any client or taxpayer who is a importer, whether manufacturer or trader, whoever it is, it doesn't matter, or exporter. So it is advisable that they also get a AEO status, authorized economic operator status, which is actually a simple process. Okay, so that also you may advise the taxpayers to go for it, and that's a good cost saving for the taxpayers also.
Yes, sir.
Yeah. So I think
there is no more questions in our chat box.
Yeah.
I think we can conclude the session, sir.
Yes.
Over to Jagannathan Anand, sir, Secretary of Salem, the Secretary of Erode branch.
Yeah, thank you, madam. Audible, na?
Yes, sir.
Yes.
Good evening, everybody. My sincere thanks to today's faculties. Mr. V.K.Subramani, sir, of course, he is from our own branch. So we are very happy to have him as our faculty today. And Mr. T.R. Srinivasan, sir, both of them have presented very nicely and in a very detailed manner about direct tax and indirect tax. Thanks a lot, sir, for such a wonderful presentation today. and we are all happy with the way actually the meeting went on. It went on very well, very nicely. I thank both the chairman, actually Erode branch and of Pondicherry branch for arranging such a wonderful session today. I also thank all the participants for actually giving their time and energy today and making it a grand success. Thank you very much. Thank you all.
Thank you. Thank you all. Thank you so much, madam. Thank you.